We still think the market can move higher in 2024.
I think this is a fairly decent nominal growth environment.
We do think that there is a chance that there will be upside surprises in the economy.
The U.S. economy might actually re-accelerate over the coming quarters.
We should be celebrating that this economy is quite good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market on the S&P 500 just about positive. The main event, 8:30 Eastern Time. TK, it is drumroll. CPI Thursday.
Yeah, we're here. We're here, and then on to the banking tomorrow. I'm going to conflate them all together in a moment, but to get specific, John, about 8:30 and CPI, how important is the next day in PPI that nobody's talking about, where you get a disinflationary trend of what the public's doing, core the headline, but also what businesses are doing with PPI.
And the data point neither of us have just discussed, which is jobless claims, which comes out later on this morning. And Tom, jobless claims, 202, previous read, 210. The estimate today. That is historically incredibly low to see claims still down here.
I'm going to give you the statistic from the Ohio State, and that's Columbus, Ohio. Unemployment rate 2.80%. How is that stress? I mean, it's fully employed America to a lot of people. And John, that rolls right over to a market with a bid yesterday, ex-Boeing, and a further bid today as well. That's a complete bit dog bid.
And a little sprinkle of Fed speak in between. We'll talk about bit dog.
Can you see how I look different?
A little bit later. What have you done?
I've been put on a list of Bitcoin idiots.
Have you? Yes. Is that an official list?
I guess it's a list.
Who is running that list?
On behalf of Senator Warren of the Commonwealth of Massachusetts.
Oh, Senator Warren's running it?
Oh, yeah. No, she's on the list.
Oh, she's on it?
Yeah.
Okay.
Somebody's running the list.
Is she above you or below you?
Oh, she's way above me.
Way above you. That's good to know. That's good to know as well. Sprinkle of Fed speak in between today, not just about the economic data. We'll catch up with Loretta Mester later. I'll give you the time of that in just a moment. I want to reflect on what we heard from John Williams, the New York Fed president, yesterday afternoon. Tom, I expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals. The Fed on repeat.
I want to synthesize this in, John, and we'll do this all through the show today. And folks, you're going to see this with us tomorrow as well. Mark Cabana with the blistering first great research note of 2024. Cabana of Bank of America conflates Powell, Mester, all the challenges they have, into what Jamie Dimon's going to tell us on Friday, and it all redounds and synthesizes from the Fed, the big banks, down to the tensions of our small banks in America. The Mark Cabana note, hugely sophisticated on reverse repo, is there's a real tension out there beneath all the headlines Thursday, Friday.
It's a fascinating finish to this week, going into the weekend. A few more days to go. Let's get to the price action. The scores look like this on the S&P 500. Positive here by 0.1%. Yields come in 3 or 4 basis points. The 10-year still in and around 3.99. In the FX market, the euro doing absolutely nothing once again. 109.69. That currency pair pretty stable, almost unchanged. Negative here by 0.02%. Here's the calendar. Here's the next day or so. Coming up a little bit later, here's your morning brief. CPI 8:30 Eastern Time alongside jobless claims. Look out for all of that. Then the Fed speak today. Loretta Mester with Michael McKee coming up on Bloomberg TV and Bloomberg Radio. A conversation, Tom, you do not want to miss later on today.
I don't think McKee knows the questions to ask until he sees CPI at 8:30. That will change the dynamic, the discussion with Mester of Cleveland.
Makes that Fed speak just a little bit more valuable, Tom, today as opposed to yesterday, so they can respond to the information that comes out later.
Bramo's not here, so this, it's clearly.
Do you want to get to the bank
earnings? Should we have an auction today?
Tomorrow. We won't talk auctions, we'll talk bank stocks. Bank earnings tomorrow, JP Morgan, Bank of America, Citi, Wells Fargo, all of that still to come. The standout picture on that board, Tom, and you've said it a few times, just to see B of A over the last 12 months down by something like 2% and JP Morgan up by 22%.
Right.
One of those is not like all the rest, and it's JP Morgan, which has just outperformed beautifully in the last 12 months.
It's Sesame Street banks tomorrow. And, John, what I would say is when in doubt, they're going to do what they do, which is job cuts. And I'm really interested, not so much in the conference calls, but in the next 2-3 weeks to see how they rationalize forward.
BlackRock set the tone for that earlier this week.
Absolutely. And it wasn't 2 or 3%, it was more.
TK, do you want to bring in our next guest? They won a wonderful prize. A wonderful prize.
Yeah, let me explain this, and this is honor Fred Wiegold, who was just magnificent at Bloomberg. He invented the Wall Street Journal Beauty Contest. on what you do on the street. And all of that led off of institutional investor and what they do in polling and trying to figure out who makes the fewest mistakes across a given year. Christopher Verone is with Strategas. He does technical analysis and macro strategy, and he joins us this morning after adding a trophy to the mantle at home as well. Did you have a cigar with Jason Trennert?
Oh, we did, yeah.
We did. And I'm sure it was one that a better cigar than you would have had with me. Let's talk about the why of this. What do you need to do in X's and O's, point and figure, exponential moving averages? How in God's name do you win a trophy in technical analysis?
Listen, I think our approach is very simple every day. We simply try to put provocative charts and ideas in front of people. The goal is always to be as correct as often, but the reality is you're never any more right or wrong than anyone else. But are you pragmatic or dogmatic? And we really try to be pragmatic in our thinking.
You're on trend analysis, and I am. Chris and I, folks, theoretically are on the same page versus something called stochastic analysis. Torsten Slok, who doesn't believe in your smoke and mirrors, came out with a memo yesterday at Apollo and said the variance, the standard deviation of all the forecasts, the stuff John, Lisa, and I talk about every day, never has he seen this variance. Do you see that variance in your technical analysis?
Well, I think what we've seen certainly over the course of the last year is a lot of the correlations and rules that a lot of people have built their careers on were either ineffective or didn't work or on delay. And that's where I think there's value in trend following and prices and momentum, because it allows you to forget about the things that don't make sense and instead focus on what the tone of the tape is, and the trend here has been up. So we kind of evaluate things from the standpoint of what's the status quo. Status quo is the trend is up, and what could upset that? What do we have to be on guard for that would change the perception of the status quo?
Let's talk about the banks going into earnings tomorrow. How are the banks performing?
Technically, they act great. I mean, we're talking about 85% of financials are in an uptrend. That's one of the better readings we've seen in the sector in probably 2 or 3 years now. I think importantly, when you go group by group within financials, something we always do, what does the consensus perceive to be the weakest corner of the market? And then we evaluate, is it actually acting as the weakest corner of the market? And for a long time, small cap financials or small regional banks, community banks have been perceived to be the weakest corner of the market. They act great here, John. So it's hard to say the market really reflects that anxiety. You could do the same thing in REITs right now, right? When you travel around, what do you hear? Oh, it's Manhattan office that's very weak, or it's West Coast office. Well, look at the office stocks. They actually trade really well. So we can be worried about those things intellectually, but does the market allow for you to position in that direction? That's the bridge that my work is trying to cross.
Well, let's introduce the tension cross-asset. Yeah. Is the Treasury market supportive of what you're suggesting will happen and looking to happen in bank stocks? Just that stability we've seen, even the 10-year yield just sort of hanging out around 4% now at 3.99.
You know what I think is pretty interesting, John? The yields peaked, I think, October 27th at, call it 502. They come down to 370, 380. As they move, as they make that move lower, a lot of the speculative stuff works. A lot of the financials work. Things like biotech work. The last 2 or 3 weeks, if yields have crept back up to 402, the same stuff has persisted. So it seems like the market's actually moving away from being so obsessed with what every tick in bond yields is. My case on yields is we probably bounce into 430, 440 here, and then we can evaluate. I'm in the steeper, curve steeper camp. I think we're losing twos, particularly as we move through Europe. But generally speaking, 430, let's reassess what the call on 10 should be.
I'm going to suggest Dorsey Wright really invented modern relative strength analysis. Folks, this was a Bible. You'd get it printed out. This is back when we used quill and dipped it in the ink. And the answer is Dorsey Wright basically invented this. And the cardinal rule is you can go short if the market's short, the sector's short, and then you find a stock to go short. That ain't happening right now. How do people go short, bet negative in an up market with selected up sectors as well?
Well, I think your best chance for shorts right now are relative shorts, not absolute shorts. And the way you describe it, Tom, is absolutely right. If you're going to be short, you need the market helping you. There's an old saying, you're only a good short seller basically by luck if the market's helping you. And when you go stock by stock or sector by sector right now, if you're going to look for relative shorts, it's still probably consumer staples here, right? They're the weakest relative performers. You could say there's still stuff in energy or basic materials, which are relative lows. But most of the sectors that we really spend a lot of our time trafficking in, discretionary or industrial, still pretty firm.
So bring it over to Magnificent Seven. I'm a big believer that Magnificent Seven are each individual stock stories, each individual charts. But what is their technical construction now, given the carnage of Jan 2, 3, 4, whatever, and the huge bounce back of the last number of days?
Well, I think the way you phrased that, Tom, is important to kind of frame our thinking. Last year, this was a very monolithic group. And our kind of thinking on Mag 7 this year is it's not a monolithic group. And you're already beginning to see that here a little bit. So Apple, as we know, the most important stock in the world, has not necessarily been involved the last few weeks as the others have. I have Microsoft at new highs, NVIDIA at new highs, Apple has lagged. So there's a bit of a shift there. I think it's the first clue on that front.
The earnings profile of Apple compared to, say, NVIDIA is very, very, very different. Your thoughts on Apple going into the new year? I believe we get earnings in early February, start of the year with 2 downgrades, Barclays, Piper Sandler. Your thoughts on the performance of that stock, the multiple expansion we saw, and the iPhone almost going ex-growth, in fact, going ex-growth over the last 12 months.
So I'll let the smart people worry about the fundamentals on why something may or may not be happening, but I'll frame it like this. The low in Apple in October was 167, right? Stock trades, let's call it mid-180s right now. If the tone of the market's going to change, it probably happens with Apple below the October lows. I'm very big on this idea of every year start with reference points, right? Under what levels would the status quo for the market begin to change? As the market's most important stock, I think quietly, if Apple gave up 170 on the downside, you would say, okay, that's a meaningful change. That is new information relative to what we've seen over the last year.
TK, Apple closing yesterday at 186.19.
It's a raging battle, but my recollection is we had the same raging battle, John, 90 days ago. I don't think obviously it's a different story. But
no, you're absolutely right, Tom. The things we're saying about Apple today, you could have said 90 days ago, and the stock performed beautifully through the year, up something like 48%.
John, if there's a difference here, if you look at Apple relative S&P, it's actually undercut its October relative performance lows. So again, it's the first of this kind of Magnificent Seven group that has actually seen some legitimate relative deterioration. So I don't think it can be owned in the same size as maybe 6 months ago.
Interesting. Chris, this was great. It's good to see you. Congratulations, too.
Thank you. Appreciate that.
Thank you, sir. Chris Ferrone of Strategas, a bad company. TK, great start to this morning. CPI coming up a little bit later. We're going to talk to Skylar Montgomery-Koenig of TS Lombard. We'll do that at 7 a.m. Eastern time, so in the next hour. We need to talk politics as well, Tom. We're going to speak to John Lieber, I believe, of Eurasia Group shortly.
It's going to be interesting. Iowa upon us. It's on Monday, Martin Luther King Day. And, John, you'll be traveling to Davos. I think Iowa will be most interesting. Michael Shepard and our team in Washington really giving us good coverage on that. But then it's on to New Hampshire, and after the debates last night, I just have no idea. I'm worn out by the back and forth juvenilia. I can't process it.
Do you want to teach Governor Christie about hot mics?
Did you
hear that yesterday?
Somehow there'll be another. Somehow there'll be another lesson. That John Ferro.
A lot of people criticize Governor Christie over the hot mic, but it happens, TK. When you get comfortable having a microphone on your lapel, it can happen. But it happened yesterday, and he had some things to say about Nikki Haley and Ron DeSantis. To turn around and tell someone that Nikki Haley's going to get smoked, to talk about your ROI of what you've spent on advertising and the return you've got for that. I mean, pretty revealing comments.
Yes, but it's vintage Chris Christie.
Sure.
He's sort of been doing this for decades.
I just love finding out what people actually think about a certain situation.
I think Chris Ferrone
Never mind like the varnish of sitting there in front of people when the news conference goes live and you say the things you think you've got to say. I'm interested in the things that people actually think, and I think we got just a little snippet of that. Did you
get your orders in for 930 Bitcoin? And you slide into an ETF?
I didn't. Did you?
I saw you on a conference call. He's on a conference call, folks, an hour ago with Kathy.
I was on a call, that's true. But not with Kathy.
Kathy, what do you think?
Equity futures on the S&P 500, just about positive, up by 0.1%. Chris, thanks for joining us. Good to see you. The 10-year, 3.99 from New York City. This is Bloomberg.
We don't need another mealy-mouthed politician who just tells you what she thinks you want to hear just to try to get your vote.
He has switched his policies multiple times, and we'll call that out tonight. But every time he lies, Drake University, don't turn this into a drinking game because you will be overserved by the end of the night.
When you need someone standing and fight for you, don't look for Nikki Haley. You won't be able to find her if you had a search warrant.
How did you blow through $150 million in your campaign and you were down in the polls?
So here's
you are
I think
not
this
a manager.
Is very
No,
instructive.
now I'm going to say.
I think it's very instructive about how Nikki Haley sees the world.
I think I have the floor.
GOP presidential candidates Ron DeSantis, Nikki Haley sparring on the CNN debate stage yesterday. The two Republicans calling each other liars, exchanging insults throughout the evening. All this, TK, ahead of Iowa on Monday.
Yeah, we had a drinking game at the Keene household last night. Every time I was fed up with this debate.
Zeitgeist.
every time that was just, I'm sorry, irresponsible. I am so worn out by the childishness of this. It's painful. There's no other way to put it.
As a practical matter, we're down to 2, Tom.
Is there any equivalent
imagine
of that
after
in the
Monday we
United
go down
Kingdom?
to 1? Yeah, Parliament every single week.
Okay.
To be fair,
Yeah.
I've got to say, Tom, I wish I saw more of that in Congress. In
Fair.
Washington,
Yes,
D.C.
I agree.
I'd like to see a robust exchange of views. You don't want to see the slang the insults, slinging insults either side, Tom. But ultimately, you want a fiery debate, of course.
Emery Horton, she's going to be with us in the next hour?
Later this morning,
her
yeah.
people said she can make it. That's good. Emery Horton to be with us in the next hour. Right now, we get a brief, an informed brief from John Lieber, Managing Director of United States at Eurasia Group. Of course, they're out with their top risks and far more. His work for the gentleman from Kentucky, and there is only one gentleman from Kentucky years ago. John, I look at this, and I'm going to dismiss DeSantis just because that's what the numbers tell me to do. Is Haley running for vice president?
That's a great question. She would be a very good vice president. She's right out of central casting for President Trump. She's got great foreign policy experience. We heard that last night. Her views on Ukraine are well-informed. They're forceful. It's the part of her campaign that's most compelling. The challenge is that I don't think Trump likes her all that much. And, if you look about Donald Trump's motivations, he tends to be motivated by either somebody out of central casting, which Haley is. She matches up really well against Kamala Harris. But he's also seems to be motivated out of spite. And unless Haley starts saying some really nice things about him soon, I think that he's going to look elsewhere.
And for those of you on radio, John Lieber, the only reason we have him on, he's got this absolutely cool banjo in the background. Let's go to Bill Keith and your Kentucky deliverance that's out there from movies long ago. Are the Republicans going to get deliverance in New Hampshire? Is New Hampshire going to change the dialogue?
I think Trump looks pretty good in New Hampshire. With Christie out, this is where Haley has a shot to consolidate the field. But Iowa still matters. I mean, if DeSantis is a close second in Iowa, which I don't think he will be, then there's a chance that he could rally some of his voters and make a deeper push into the spring. What's more likely to happen is that DeSantis is a distant second or maybe even third in Iowa, and then it's Haley's race to lose in New Hampshire next to DeSantis. But Trump is still the dominant force. He's way up. He's going to blow everybody out in Nevada. He's going to blow everybody out in Michigan. And he's probably going to win South Carolina. And it's going to be really hard for either of these two to consolidate the field if they don't win a single state before Super Tuesday. So this is now still and has always been Trump's race to lose.
The working assumption is it will be the president, the former president, Donald Trump, who will be the candidate. John, we've seen the approach from the current president, President Biden. His approach seems to be, it's me or it's democracy under threat. It's him or it's democracy. And John, I just wonder, how successful do you think that approach is going to be on the national stage?
Well, look, the debate last night got all the attention, but I think the main show was actually on Fox, where Donald Trump was giving a town hall, and he was pretty good. He was funny, he's charming, he showed command, he showed leadership. I think that's going to contrast really poorly with President Biden, who's, there's no other nice way to say it. He's getting up there. And, whatever Biden says about Trump, Biden's got to run a very negative campaign against Trump in order to have a shot here. And he's got to convince voters that, ignore the inflation, ignore the wars overseas, this guy is terrible, and I'm here to remind you of why. I think that's a really, really difficult argument to make in an environment where your popularity is in the high 30s and people don't feel good about the direction of the country.
John, I'd go one step further.
Here.
I'd say he's got to actually run a campaign because he didn't need to last time around. We were in the pandemic. He could sit back, make it a referendum on the sitting president. He won. How different will this campaign be compared to what we saw back in 2020?
Yeah, that's a great point, John. I mean, I think that it is an unusual presidential campaign where you're having two ex-presidents, a current sitting president and an ex-president running against each other. You could credibly try to make this a referendum on Trump, but you've got to remind voters what they didn't like about Trump in the first time. And Biden is just not a vigorous, forceful campaigner that can really make that case. He's going to have to do it through proxies, and he's got a lot of baggage. So it's a big challenge.
To your service with Senator McConnell in the nation, what should the senator from Kentucky say to Nikki Haley? I mean, they're comrades in arms, North and South, if you will. What does Mitch McConnell say to Haley to prosecute the best path over the next number of months, say to Super Tuesday?
I think he says, good luck. Make sure you got enough money to spend on ads and make sure your ground game is really good, because that's the only way you're going to have a shot at beating Trump. And the big thing is going to be money, right? You've got to keep the donors motivated. You've got to make them believe that you have a real shot here so that you can prosecute this campaign.
It doesn't matter how Haley polls against Biden. That just is not part of this discussion.
It's not what's motivating voters. I mean, you just don't see primary voters in the U.S. acting strategically. If you did, you'd have a much more vigorous challenge against Biden in the Democratic Party, and you'd have people, thinking about looking ahead to the general election in the Republican Party, but you don't. And people are motivated by their emotions. People are motivated by the guy they like and the guy they think is fighting for them. And that guy is Donald Trump right now.
John, the world is watching. You've put out the top risks earlier this week. Number one, it's pretty original, although probably widely expected. It's the US versus itself. Now, John, as you know and have explained over the last few days together with the team at Eurasia, this is going to have huge consequences on several fronts around the world, including in Ukraine and what's developing right now in the Middle East as well. John, when you speak to clients at the moment, especially the international clients, what are they talking to you about? What are the questions they're asking about this election this year? And ultimately, what are you telling them?
Yeah, our international clients are acutely aware of the U.S. election. They followed extremely closely, and I'm always impressed and a little dismayed at how much knowledge they have about the U.S. political system, because they got better things to do with their time than pay attention to the Electoral College or what reconciliation is. But our international clients are quite concerned about the return of Donald Trump. One of the things that's always highlighted to me is whether or not the U.S. is a reliable partner for the rest of the globe. The U.S. led the security coalition in favor of Ukraine. It's planning to lead, it's positioning itself to lead a security coalition to defend Taiwan. It's Israel's biggest backer globally, which of course isn't all that popular in the rest of the world. But can the U.S. be relied on when you have deep partisan divisions that mean the policy pendulum swings violently back and forth depending on who wins the White House? This is a huge question on top of mind for a lot of our clients, particularly our European clients, who are very worried about future President Trump's commitment to NATO and the shield of protection that provides for them.
John, let's go there. Let's talk about the Europeans. Maybe we can reframe things. Have the Europeans proven they can be reliable partners to the United States on certain issues? And I'm thinking specifically of China.
That's a great question. The Europeans are acting very mercantilist in their commercial interests when they're thinking about China. The U.S. has been a leader on this front. The Chinese use economic coercion to their great benefit and have been doing so in Europe. And you look at, Germany last year, Scholz sent over a coalition of German industrialists to China in order to deepen their trade ties with China. But I don't think this is the number one issue in Europe right now. I think Russia's the number one issue. And it is for the U.S. and it is for the Europeans as well. And this is an issue that, they're very freaked out about. They see the threat that Russia poses on their border, and they need the U.S. to help them defend it. And if the U.S. isn't there, it's going to drastically change the balance of power in Europe in a way that we haven't seen for almost 100 years.
Super thoughtful stuff. Appreciate your time this morning, John. Let's catch up again soon. John Lieber there of Eurasia Group. TK on the election still to come in 2024, the domestic story and the international consequences.
And again, my takeaway there, other than the really interesting questions you had, John, and like how Europe perceives this, is ever more the primaries are polarized. I mean, if there was a legitimate Democratic primary this year, I think it'd be exactly the same. You've got it with RFK Jr., but the bottom line is the primaries are highly polarized versus where we're going to be the third week of October into that November election.
Equities on the S&P 500 positive here by 0.1%. It is CPI Thursday. That means we're going to catch up with Julia Coronado of Macro Policy Perspectives. That conversation up next. Equities up on the week, up on the session in the equity market right now on the S&P 500. Just a little bit higher, positive by 0.1%. The Nasdaq, Tom, up by 0.4%.
You know, I'm like Ace Greenberg. I got the buy and sell tickets on the left and the right, and I'm trying to get the buy ticket out for that first odd lot purchase of Apple, and I just can't pull the trigger. You know,
just sticking in cash.
Well, you look at January 2nd, 3rd, the world's come to it. And remember, like a weekend long ago, deep into 2024,
I wouldn't go that far, but yes, people were questioning what could go wrong, and things have started to go.
It's done.
Right again. Equities are up. We're grinding closer and closer back towards all-time highs. In the bond market, just some stability on a 10-year, contributing maybe to that better tone, better sentiment in the equity market. 4 straight days, I think we've closed above 4%. We're a little bit lower this morning by 4 basis points, 398.28, Tom, on a 10-year.
Real yield 1.76%. I'm watching it carefully. I think there's a raging debate as it centers around the inflation adjusted yield, and you know, maybe we'll get a lot more information here at 8:31.
The 10-year is basically where it was after the Fed meeting in the middle of December.
Program note, Ed Yardeni publishing late last night makes real clear with a gallon of gas and other used cars, rents. Yardeni wonders, okay, here's survey, and maybe we just come in light given these, particularly rents.
Well, let's get to that. Under surveillance this morning, your top story, US CPI. That data is a little under 2 hours away. The median estimate in our survey expecting a 3.8% read on core inflation, down from a month ago. New York Fed President John Williams saying, quote, "My base case is that the current restrictive stance of monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal." Tom, as you know, politics, headlines, newspapers might focus on year over year. I think the consumer's still feeling the cumulative inflation since 2020. Wall Street focused on month over month and the more shorter-term trends and what they inform the Federal Reserve about the future.
John Williams and his former mentor Bill Dudley at the New York Fed, Bloomberg opinion columnist, will look at some form of annualized statistics. I'm going to go with Jason Furman. I'm sure we'll see this morning out of Harvard, where he takes a matrix or sum of different annualized calculations. And that's sort of where I'm going to be. And the answer is 2-ish, 2.2-ish, 2.3-ish, and that's awful near-ish where John Williams wants to get.
This is a clinic.
It's a clinic.
This is good. We'll get an actual clinic from Julia Coronado in just a moment. Stay tuned for that. I want to bring you an update on Boeing. A quick return to the skies unlikely for the MAX 9 jets. Transportation Secretary Pete Buttigieg not offering any timeline, telling reporters, quote, "The only consideration is safety. That's going to dictate everything. Nobody can or should be rushed in that process." Alaska Airlines have already cancelled all flights on the MAX 9, Tom, through Saturday.
We had a new FAA guy come in, Mike Whitaker, I think's his name. We featured him on Bloomberg Radio yesterday, Paul Sweeney and I. What did Buttigieg and the new head of the FAA do? Alaska Air is going to look at what, 14 Boeing 737s? What if they find one with loose rivets?
I know.
I don't really see where this is going, other than a bad outcome for the nation.
So Jeffrey suggested that maybe we could get this plane back in the sky over the next week. I think the Transportation Secretary is tempering some of those expectations just a little bit based on those comments. Let's bring you the roundup from Iowa just quickly. Insults flying on the debate stage yesterday evening. Republican candidates Nikki Haley, Ron DeSantis squaring off ahead of Monday's caucus, repeatedly accusing the other of lying. The favorite for the Republican nomination, Donald Trump, skipping the debate, instead hosting his own town hall, counter-programming Tom on Fox News last night.
The former president has been brilliant on this. He's just not going to participate. And I really wonder, forgetting about Trump and Biden at their August age, is this a new trend where heavyweights within any campaign say, we're just not going to do the childish back and forth?
I think it's a strategic decision to say, look, I'm the former president. I'm not participating in the primary in the way that you are. I don't need to. I've got a massive lead. You're struggling to catch up.
Right.
What's in it for him? Why participate?
John, have you ever seen the video of John F. Kennedy and Richard Nixon, 1960?
Yes.
That, you know, we don't want to get back to that. You know, that's just too nostalgic. But there was just a grace to it, as Kennedy said, "I'm the young one," and Nixon struggled. And that's what the nation wants to see. They want to see the vitality of these
Can you imagine
people and not one-liners.
There's two individuals that are front runners for this race, talking about who was the young one on stage and how it would go down.
In black and white. Maybe you'd want to put it in black and white and make it more theatrical.
If we get to our next guest.
Let's get to our next guest. Julia Coronado joins right now, founder, president, Macro Policy Perspectives. My head's spinning over debates. Let's talk about the debate at the Fed with Dr. Coronado right now. Let's sharpen the debate, Julia, and go to the real yield, which has exploded up to a breaking level. We're breaking, not breaking like snap, but slowing down the American economy. Where's the appropriate 10-year real yield right now? Are we restrictive? And it's got to come down.
Yeah, I think it is clear that the Fed has policy in a restrictive place. We see that in the cost and availability of credit. And yes, when we look at things like the hiring number, the GDP has been a lot more volatile. But hiring's been slowing pretty steadily. And even John Williams said yesterday, the risks are pretty balanced right now. So inflation's been running low. We're going to get another print that's probably going to be in the moderate zone this morning.
Let's go to University of Texas. What's the measurement of CPI you use on an annualized basis? I go to 3-month annualized just because I can't do the math like you can. Do you aggregate a set of numbers like Jason Furman, or is there a Coronado calculus?
Yeah, no, we look at the same 3, 6, 12. 3 gives you the highest frequency, a little bit more noise there. Chair Powell has told us to look at the 6-month annualized. When we look at their preferred measure of PCE inflation, core PCE inflation is already there. It's already
exactly.
At 2%.
So what are we waiting for? Thank you.
So what are we waiting for? Just more confirmation?
I want a January rate cut. John, am I out of line?
Possibly, yeah.
Possibly.
That's a little bit greedy, Tom. That's a little bit greedy. I think the January data last year, if you'll recall, we got some changes in seasonal factors in the CPI and some surprisingly strong January numbers. I think that the Fed wants to get through the January numbers that we'll get in February.
Fair.
But if that stays in the zone that we've been in, which is what we expect, then it really does beg the question, what are we doing at 5.5, right? We do not need to be here. The real yield is rising. Hiring is slowing. Everything in the economy is telling them things are balanced. It's time to start adjusting the nominal funds rate.
Julia, John brought this up a couple days ago. Kathleen Bosjancic at Nationwide was brilliant on this yesterday. 2.8% unemployment in Columbus, Ohio. Just as, they're all at the bars, getting ready for football and spring sports. Julia, the bottom line is, if we back up the unemployment rate in Columbus, Ohio, we get to a horrific 4%. Is there a new bad unemployment rate for the Fed?
I think that the Fed is very pleased that the unemployment rates stayed as low as it has. Under the hood, there is some indication that the labor market's a lot more balanced. Hiring has slowed, wage growth has moderated. Employers are telling them, their own district businesses are telling them it's easier to hire and retain workers, a lot easier than it's been. So turnover has slowed down a lot. The churn in the labor market has really, really normalized. So that is where, even though there's a low unemployment rate, the problem with the unemployment rate and fine tuning the economy, the U.S. economy is an ocean liner. If you get to the point where the unemployment rate is rising steadily, you may not have control over that dynamic anymore. The idea of a shallow recession is always a beguiling idea, but the U.S. economy generally doesn't work like that. Once you're in a zone where businesses are laying off workers, that tends to feed on itself. So you probably don't want to get there. And as long as the labor market is not generating inflationary pressures, you don't need to get there. The Fed has some unusually great trade-offs right now that it's facing. And it sounds like they might be willing to take advantage of that and explore the space a little bit by starting to adjust that nominal funds rate lower. Not in January, but we think that by March, the data are going to be telling them that they can begin a process, a sequence of adjustments. Nothing to hurry because the labor market's pretty resilient and solid. But, again, we don't need to run the risk of tipping the economy over.
Julia, you mentioned the rebalancing in the economy. Has that been the product of time, just time past, or has that been the product of Federal Reserve tightening? Can you identify which one it is, and how difficult is that for someone to do?
It's both, clearly both. And when we look at sort of inflation from a sectoral standpoint, you can start to see where it is that the Fed's policies are cooling things down and where it is that just normalizing supply chains and easing pandemic frictions are bringing inflation down. And it's really a combination of both. Actually, the car market's a perfect example of both. Chips are available, production is rising, inventories are rising. Dealers are having to compete on price again. That's clearly a easing pandemic friction story, but it's also a demand story because car loans are real expensive at these levels of prices and at these interest rates. Those payments have soared, and dealers are telling us that at these levels of interest rates, there is no more pent-up demand, and they do have to compete on price. So it's really a combination of tighter policy and just an economy that's functioning a lot better.
I ask because I'm wondering how effective monetary policy tightening has actually been, Julia, because we used to talk about, not so long ago, a few months ago, in fact, the long and variable legs of policy and how much was in the pipeline was still about to hit the US economy. How are you thinking about that now, Julia? Is there a channel you're still waiting for that tightening to show up into the economy?
We've clearly seen a lot of the tightening hit the economy. What you see is in the credit multiplier. So if you look at credit flows and the availability and the cost and the amount of bank credit flowing and just the general availability of funding, even for things like in the private equity space, it's a lot tighter. Money is not cheap right now. Money is expensive. Right. You really have to prove your concept. You have to have a cash flow business to get funding, and there's just less funding that's flowing around. That tells us that policy is tight, and that's starting to bite. It's starting to hit the economy, slow it down. We're in a much more sort of trend-like zone for growth. And again, hiring has been slowing pretty steadily and narrowing its base. So we can see policy. Is there more yet to come? I think yes. I think, again, credit flows over time. The less that's flowing, the more that kind of begins to restrict investment and other interest-sensitive areas of spending.
You're the one selected today. Stephanie Kelton, in a podcast text in the Financial Times, regurgitates modern monetary theory, of which she is noted. She goes right after the Dr. Coronados of the economic world. And the basic idea here is debt's okay. With our growth rate where we are, going back to Stiglitz, where our growth rate is, our debt rate is fine, no big deal. You just told me that we've got a slowdown because we're encumbered by debt like commercial real estate, et cetera. Is debt a problem right now, Dr. Coronado?
Well, debt is part of making yields higher. I think that we can see that in the bond market dynamics, that the fact that supply is a lot more supply needs to be absorbed has been a factor leading us to this leg up in yields that we've seen. Is that a problem? Well, actually, the U.S. economy has been functioning kind of surprisingly well at this level of interest rates. Part of that is not about policy. That's about productivity that's been a lot better. And we are a bit optimistic that that can be sustained. So you might be in an area where both because the debt level is higher, but also because productivity is higher, we might be in a zone where interest rates stay a bit higher this cycle than when we were pinned at the zero lower bound and effectively in a liquidity trap. So I think it's a bit of both. It's not that these yields seem to be particularly problematic, but they could stay higher for a longer period of time.
This was the clinic we were looking for. Thank you. Appreciate it. Thanks for catching up. Julia Coronado there of Macro Policy Perspectives, Tom, on the potential for a Federal Reserve to maybe in a position to be thinking about cutting interest rates, not in January, but potentially in March.
My emphasis would be, John, there's 8 ways to slice this. And as we open the show with Mark Cabana's work, part of this is about the financial system. Ben Bernanke's care that we really need to have a robust financial system. I think JP Morgan's doing okay.
That bank is robust.
I'm worried about another 1,000 banks that nobody ever talks about or thinks about.
We're going to talk about those banks up next on the program. Erica Najarian of UBS looking ahead to big bank earnings kicking off tomorrow morning.
I think there were 3 banks that got it wrong. I've said that publicly. They made choices that were the wrong choices. Wasn't complicated. They got washed up and cleaned up and folded into other banks, and you move on. This wasn't, people kept telling me we're having a banking crisis. I said, no, we're not. We had a crisis among 3 banks. It was a crisis for their shareholders and their employees. It's not a crisis for the market. The core banking system is in rude good health, to use a British expression.
And that was the view of the brilliant Morgan Stanley chairman, James Gorman. The KBW Banking Index showing that good health, rude good health, at more than 25% since the start of October. The first read on the banks this year coming tomorrow with JP Morgan, Citi, Bank of America and Wells Fargo reporting earnings. But Erica Najarian of UBS warning, quote, given the fourth quarter rally in the BKX and a sharp turn in sentiment heading into this year, we think January earnings season may present a speed bump to the sector's recent momentum. Erica, I'm pleased to say, joins us right now. Erica, great to catch up with you. Let's go straight to it. What is it about this earnings, this group of earnings, that you think might be that speed bump?
It's really, to use James' term, a rude awakening for earnings. So it's not necessarily about the absolute price level, and it's not necessarily about the absolute multiple on earnings, but it's that earnings aren't going to go up. You know, as a reminder to everybody, what happened in the rally is we priced out a negative, and that negative was the unrealized bond losses on bond portfolios as Treasury yields were shooting higher. And so now we've removed that negative, but keep in mind that banks are actually positively rate sensitive. What that means, Jonathan, is that, you know, if the Fed is cutting rates, then you actually will have pressure on net interest income, especially in the front half of the cuts.
Erica, I'm looking at your coverage of the big banks, and I want to ask you about banks you don't cover, which I know is out of bounds, but I think it's really germane right now. Do you perceive the divide between 20 or 30 big banks and everybody else out there, and the concern that the smaller banks of America are not in rude good health?
They may not be as strong as the top 20 banks, but I think if the forward curve pans out, they will get a lot of relief in 2 ways. One, they'll get relief in deposit costs. And I think what you have seen in 2023 is a nice run up in deposit costs as the Fed tightened. And so they'll get relief on the funding side. The other piece of relief that those smaller banks will get is on commercial real estate. So commercial real estate is more widely held at those smaller banks than they are on those larger banks that you mentioned, Tom. And, as such, if interest rates are coming down, that could actually narrow the subset of potential problems as we deal with commercial real estate maturities ahead.
And so to translate this, to the rescue will be a lower money market yield where billions flows out of money market funds back to a more normal banking economy. Is that right?
Correct. So I love that you hit on that. Not only will you get relief in deposit costs, but you also get that deposit flow back. So you're no longer having to, as an alternative, either, borrow wholesale at, pretty much Fed funds, or really ratchet up what you're offering your deposit customers.
Erica, what is your top pick right now going into earnings season? I know you think it might be a difficult moment, a difficult rocky patch, but ultimately, what is the top pick?
So in a difficult moment, in a rocky patch, who does the market turn to? JP Morgan. So as I think about the expectations that are now into the market, and as I think about the enthusiasm about, having these cuts without a recession, the bank that can deliver on earnings, the bank where we're most confident those earnings expectations can be delivered, is JP Morgan.
Okay, I mean, JP Morgan's out. What's it up? It's like NVIDIA. It's like the NVIDIA of the
not quite,
financial
but
system.
relatively speaking, compared to some regionals,
You're
maybe.
telling me that after massive double-digit return here, complete outperformance, that vector just keeps on going, Erica, for Mr. Diamond?
I think so. So a couple of other data points. So from the October bottom in the BKX, JP Morgan has actually underperformed by 8 percentage points. And remember what I said at the top of this segment. I said it's not really about the absolute price. It's not about the PE. It's about the E. I think that the involvement in the space today is in hedge funds and in macro funds. How long onlys will actually step in and move their weight in banks is they feel more confident that the E is not just bottom, but there is good news upside potential to the E. And again, just going back to JP Morgan, I think they're just in best position to deliver that, and so their performance can absolutely continue from here.
Do we see mergers this year? I've been waiting 25 years for the roll up here, not to get to where Canada is, but we got, what's the number? 4,000 banks, 5,000 banks. How do we cut that in half? This is the year that happens?
I don't think so, because it's an election year. So there's a little bit of a mentality here, the seller's mentality that, oh, wow, I got the bond losses back in my capital as rates have come down. And now they're thinking about what the forward curve is implying and saying, okay, my book value recovery is going to be X higher at the end of the year. And so I want a multiple off of that. Meanwhile, the buyers are like, absolutely not. And the other part of that, and since I mentioned the election, is that, there has been a lot of consternation about the length of time between announcement and close. U.S. Bancorp will tell you about that consternation. And so I think that, smart buyers may wait until we get more clarity on leadership before they think about wading into M&A.
I want to weigh in on the politics if you can. You alluded to it there. It's 2024, it's election season. Are clients asking about the regulatory backdrop going into next year off the back of who may or may not win the election this year? Is it still too early, or is that something they're considering already?
So it's something that they're saying it's too early to price in, given the many variables that could happen between now and November. That being said, they're thinking about, the banks in a positive light if we did have a Republican administration. Of course, a lot of investors are asking me about the regulatory environment. And the thought process here is similar to 2016, in that a change in administration from Democratic to Republican could potentially lead to regulatory easing, particularly now that we do have a proposal out there that everybody is hoping could be at least delayed, if not softened significantly. And so if you have an administration change and you don't have those capital rules finalized yet, there's a lot of hope of not just a significant delay, but also a potential for reissuing, that proposal with much, much, much less bite. And so that gives that gives the market hope that all this capital that the banks are building up will be returned back to shareholders. Additionally, the banks are trading at a 48% relative PE to the broad market, which I think is part of the current broad appeal. And as a reminder, the quote Trump bump between 4Q16 and 4Q17 was 75%. I think that's part of the thought process, that the bulls are thinking about as they think about, rate cuts and then a potential administration change.
That's the big one to watch. The brilliant Erica Najarian of UBS. Erica, thank you. Good to catch up. Top pick, JP Morgan into tomorrow. Top pick of the last 12 months. Guess what? JP Morgan.
Erica
JP Morgan
shows
earnings
up Friday
just around
morning
the
and
corner.
takes the rest of the month off, I guess, is what's it about. I love the Gorman thing on Root Health, John, and, with your Britishness, it's a very posh
Oh, my
kind of
Britishness,
thing.
thank you, yeah.
You go back to
posh over
Corinthians,
here.
Corinthians, but, you bring it forward, and I think the former head, whatever he is this week at Morgan Stanley, he's channeling Rudyard Kipling. And I know you had a whole Kipling phase.
The novelist,
years ago.
yeah.
But
Sure.
It was a rude sketch for Rudyard Kipling, 100 and something.
You've been doing some
years ago.
research.
I did research, yeah. Well,
Nice.
you're talking to Erica.
Rude
I'm
Health.
seeing where Gorman's heading with Rude Health.
James Gorman's going to be missed Hey?
Oh, absolutely.
Just fantastic leadership he's displayed at that bank.
And I'll go with Greg Fleming, with the Morgan Stanley history there. You'd go Greg Fleming and James Gorman, and they changed how all of us deal with this bogus phrase, wealth management. It's the managing of people's money, husbanding it for non-losses, with our shattered retirement program as an overlay, and Gorman had massive leadership on that, including the acquisition of Eaton Vance.
Looking forward to catching up with Ted Pick next week.
Yes.
That is a must-watch conversation. Coming up on this program, Skylar Montgomery-Koenig of TS Lombard on this equity market, on this CPI Thursday. From New York City, equity futures positive by 0.1% on the S&P 500. Bond yields lower by 4 basis points, in and around 4%, 398.47. From New York, good morning.
We still think the market can move higher in 2024.
I think this is a fairly decent nominal growth environment.
We do think that there is a chance that there will be upside surprises in the economy.
The U.S. economy might actually re-accelerate over the coming quarters.
We should be celebrating that this economy is quite good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.1% on the S&P, getting closer and closer back to all-time highs that we last hit in early January 2022. TK CPI, the next stop in this market, about an hour and 30 minutes away.
Markets are saying they love what they see, which is a disinflation tendency. I thought what Julia Coronado said was perfect. Dr. Coronado framing out 3-month annualized, 6-month annualized, 12-month annualized. We'll do that at 8:30. My guess is it's not Europe-like, but there's a tendency there to the shock of what we saw in Europe, 1.9%.
For 2 years now, this has been the number, the North Star for this market, for financial markets, for the Federal Reserve and policymakers, not just in the US, but arguably worldwide. Inflation. Is that beginning to shift? Are we closer to some kind of inflection point? Andrew Honhorst of Citi, attention is shifting away from tackling inflation and towards supporting employment. But policy actions will continue to depend, to some extent, on this inflation data.
I'll go with the shift. It's a nudgy thing. McKee's way better than you and I at this, but the basic idea is used cars. Other things, groceries, food. The 12-month look-back's pretty constructive, but the animal in the room, whatever series you look at, is housing, rent, mortgages, yields. 30-year fixing comes in, and rent is the dominant statistic for me today. I'd like to know what David Rosenberg thinks.
8:30 Eastern Time, we'll talk about month over month, disinflationary trends over the last 3 months, how it informs the Federal Reserve decision. We'll talk about all of that. This is the issue in the election campaign as well, Tom, but not month over month. It's about the cumulative inflation you and I have been talking about since 2020. The price climbing since then, services, goods. Yes, we've kind of faded the goods story, but still the food issue, rents, Tom, energy prices over the last 3-4 years, they're still hitting a lot of people hard across this country.
The level look back to, say, December 2019, January 2020, I think is legitimate. We don't capture that within the financial media very well. But the fact is also, with the advent of 2024, time marches on. It's going to be interesting to see how that phrase resonates at 8:30.
It's the calendar on the president's side. From New York City, let's get some scores for you in financial markets. On the S&P 500, we look a little something like this. Positive by 0.14%. Yields are lower by almost 5 basis points, 397.90 on a US 10-year. In foreign exchange, 109.80. That currency pair is positive by 0.05%. Here's the calendar. Your morning brief, it looks like this morning, 8:30 Eastern Time. CPI, jobless claims as well. It's not just about inflation, Tom. It is about claims too. 210,000 is the estimate for this morning. The previous read, 202.
Well, that goes to the fully employed America. I've been talking about Columbus, Ohio. And good morning from the Ugly Tuna 2. Great bar out there. And, you know, John, I look at fully employed America, and there's so many people watching this saying, Tom, you don't know what you're talking about. And even with claims, outstanding 4-week moving average is what I look at. There's a whole part of America that just doesn't buy the magnificent 2.8% unemployment rate of Ohio.
Without a doubt. There's a nice sequence this morning. You'll get the data and then you'll get the policy response to it, or at least the policy speaker responds. The Fed speak later today. Loretta Mester with Michael McKee. Thomas Parkin's going to be talking too in the next 24 hours. But Mester sitting down with McKee, Tom, 11:30 Eastern Time, live on TV and radio.
She is the Fed mathematician. It's going to be interesting to see what she says, and particularly off inflation data. And as I said at the top of the show, I'd overlay here PPI tomorrow. It's not like PPI, last in, first out and all that from another time and place, but there's a new importance to PPI. I'd like to hear what Mike McKee says about it.
And by the time we get to the weekend, you'll have the data, the Fed speak, and you'll have the bank earnings. JP Morgan, Bank of America,
Erica Nigeria,
Citi, Wells Fargo, Erica Nigeria, UBS.
JP Morgan.
It's very simple, Tom. Port in the storm, that's what she's saying. Things can get a little bit rocky, dicey, maybe volatile first few months of this year. Top pick, JP Morgan.
My zeitgeist headline over the holidays and the 4 or 5 days I had off, John, was the basic idea that JP Morgan captures 1 out of, I believe it's 5 profit dollars.
It's a stunning statistic.
In America. I mean, it's just amazing. Let's not forget Mike Mayo with his call that Citigroup load the boat. I mean, there's no other way to.
Yeah, looking for doubling over the next few years.
Right now.
Getting behind the leadership of Jane Fraser. That's the banking story. Let's get the conversation started this hour with Skylar Montgomery-Koenig, Macro Strategy Director at TS Lombard. Skylar, wonderful to catch up with you. Let's go straight to the data in 85 minutes' time. What are you and the team looking for in CPI?
Yeah, I think the headline, or what we really need to focus on, isn't so much this print, but it's what we've seen since the summer of 2022, which is disinflation. So we got the peak of inflation in the US in the summer of 2022. And a few months later, we got the peak in core. Now, we know that when inflation is higher, it's more volatile. You can see that clearly in the impact geopolitics has on commodity prices, which feeds into headline inflation automatically, and core through the impact it has on inputs. So we are getting inflation prints that are a bit hot. We saw that in Europe earlier this month. And core is definitely still too elevated for the Fed's comfort, but the trend is in the right direction, and that's the key for the market. So I think the disinflation story is what has legs, and it's really hard to dissuade the market of that unless we get a really large upside surprise.
Skylar, buried in your wonderful report is your mathiness from St. Andrews. You got scattered out charts with a regression line through it. How linked is EU inflation, 1.9%, major disinflation? How linked is their disinflation tendency with across the Atlantic Jerome Powell's disinflationary tendency?
So what I'll say is that European inflation certainly lags U.S. inflation. So after the peak we saw in U.S. inflation, we shortly got a peak in European inflation. The disinflation trend has picked up into the end of 2023. The big difference, though, between European inflation and U.S. inflation in the first instance was what was the main driver. In the U.S., it was both demand-driven as well as supply-driven. So the massive fiscal we got fed very strongly into the inflation in the U.S. In Europe, it was mostly supply-driven. And so that's why we're seeing such a large disinflation trend now, and it's accelerating. We expect it to be below 2% by the end of this year because supply-side factors feed out quite quickly. Obviously, there are still risks in terms of geopolitics and the inflation supply shocks there. But I see European inflation falling quite quickly.
Okay, but then is the Fed behind? I mean, I've got a massive accommodation on the Bloomberg Financial Conditions Index. I got a lot of fancy people like you telling me this Fed is behind and we're waiting for March. What's the one June is the chat after that?
Yeah, middle of the year.
Yeah, March, June. I mean, come on, Skylar. Are they restrictive right now?
Yeah, I mean, but what's the rush, right? In terms of...
What do you mean, what's the rush? John's looking at 6 bedrooms somewhere in Manhattan. That's the rush.
Don't bring me into it.
I think that, the policy rate is certainly restricted, and it's certainly feeding into the economy. But the duration of U.S. debt is very long, and so it takes a while to feed through, right? In the UK, you're looking at 2- and 5-year mortgages. In the U.S., it's 30 years. So it's a very small feed through. And so, why rush to cut rates when the economy is very strong and you still have inflation above target? What inflation being where it is in the downtrend we're seeing allows is for you to cut without seeing unemployment rise significantly, without seeing some kind of risk shock or recession shock. So that's what would really cause a rush. But right now, we're not there.
Atlanta GDP now, John, 2.20%.
Let me tell you, I need to be perfectly transparent. I need more than a 25 basis point rate cut, Tom. to buy that property.
Don't we all?
25 basis points is not going to get it done.
But it gets the emotion going.
Sure, yeah, you grease the wheels. I get all that, sure. No, I understand all of that. Skylar, it does beg the question, though, when they start cutting, and I think for a lot of people this year is a matter of when and not if, what do you think they're going back to?
Yeah, absolutely. And this is really the timing issue, right? In terms of the market is looking for significant easing in 2024. There's no one that doesn't expect easing. I think the smallest easing that one is expected is 50 basis points. But it's all front loaded. So the market price is around 200 basis points this easing cycle over the next 2 years. And I think that's fairly reasonable if you get a soft landing in terms of, it's still above their estimate of neutral, but maybe their estimate of neutral is too low. The problem is it's all front loaded. Around 140 basis points of that is in 2024.
Which CPI series do you use in America? I'm on 3-month annualized just because the math's easy. Which one do you use?
I think you need to be looking at quite a lot of factors. I wouldn't look at headline that much because it's getting pinged around by what's happening in commodity prices. Really core, and as you say, the 3-month annualized is what you should be looking at for a broader trend rather than just having the numbers ping around because you have more volatile inflation because it's higher.
I mean, I look at 3-month annualized, and then you've got all the other series of Cleveland, the Dallas, this, that, and the other. Are they of value?
Yes, I mean, absolutely. I also think it's important to look at the survey measures, as you say, in terms of if you're looking at survey measures of inflation, they're all pointing to lower inflation as well. And that's something that Europe is more worried about, right? In terms of their sentiment surveys, people are more worried about sustained higher inflation. And so it's something that the Fed has going for that the ECB doesn't.
Skylar, we'll hear from President Lagarde a few times at the World Economic Forum in Davos, Switzerland next week. What are you expecting her to say based on what you heard in the news conference? We didn't get a repeat of Chairman Powell in that news conference the 24 hours after that December meeting at the Federal Reserve. Are you expecting a change from her anytime soon?
I'm actually very worried about the ECB because I think they've already over-tightened. They're trying to accelerate QT, which will make the squeeze even tighter, and the economy is already in stagnation, and it's already worried about that. And I think the ECB has too much focus on these supply-side shocks. And so the fact that we've had shipping costs rise and the fact that we're getting potentially higher January inflation out of Europe just because of the way the calendar rolls means that I'm worried that they're going to react more hawkishly and continue this hawkish stance that would squeeze the economy more and cause more pain.
This was excellent. Can I also just say that TK is very, very impressed with the bar behind you. For our listeners who can't get to a TV set, TK, that's a pretty impressive bar.
Well, they do that. It's spring of junior year at St. Andrews. You do bar 101. I mean, she can pop a martini.
2023.
Yeah.
Skylar, this was great. It's fantastic to catch up. Let's catch up again soon. Skylar Montgomery Koenig there of TS Lombard on the path ahead, Tom, for the Federal Reserve and for the ECB for that matter as well.
We're busting her chops. She was first in class in mathematics and statistics. Brilliant. It's like a Loretta Mester in market economics. She's got her essay, folks, and we protect the copyright of all of our guests. Get it at TS Lombard. It's some sophisticated IMF-like stuff. I mean, no question about it.
You're going to say something else at the
end. I was going to say something like that.
Not stuff.
I was waiting for a Bloody Mary from Skylar.
She's the real deal. It's great to catch up with Skylar this morning. From New York City, good morning to you all. If you are just joining us, welcome to the program on the S&P 500. Equity futures look like this, positive by 0.07%. Elsewhere in the bond market, yields are lower by 4 or 5 basis points. Let's call it 398.09. Getting some headlines, some comments from Secretary Blinken in Cairo, Egypt, speaking to reporters, saying the US wants to make sure Houthi violence stops, that Lebanon, Israel and Hezbollah don't want an escalation. That's the fear. But Tom, sometimes things happen accidentally. What we saw yesterday, and we talked about it all through the morning, and we'll do so with Anne-Marie in just a moment again, Houthi rebels launching one of the most complex attacks in the Red Sea that we've seen to date. And the prospect, Tom, the potential that the US gets dragged into this almost by accident is something still on people's radar.
I am haunted forever, and it wasn't a drone. It was an Exocet missile in the Falkland Islands. This is not equivalent in any way to what the British saw in the Falkland Islands. But come on, you got 18 drones up in the air I pretty much at the same time, I guess, and that's where you get, John, to where one thing breaks and all of a sudden we lose control. That's the worry.
Our attention is really going to turn to that in the next 10 minutes or so. Bloomberg's Anne-Marie up here in New York City is going to sit around the table and break down some of these issues and respond to the debate we saw last night between Governor DeSantis and Nikki Haley, and the counter-programming we saw from the former President Donald Trump on Fox News at the same time yesterday evening. AMH is coming up next. Later in the hour, we'll catch up with Norman Rule, the former senior US intelligence official. We'll catch up with him in about 30 minutes' time. Linda Dussel is coming up shortly as well in the next hour or so in the 8 a.m. hour from Federated Hermes to break down what she sees in this equity market and fixed income and beyond on this CPI Thursday. The inflation data, 8:30 Eastern Time. That is just around the corner. Equity futures on the S&P just about positive from New York City this morning. Good morning.
I think what happened on January 6th was a terrible day, and I think President Trump will have to answer for it.
I think there's a larger issue Republicans have got to think of it. Donald Trump's going to lose that appeal. He's going to end up going to trial in front of a stacked left-wing D.C. jury of all Democrats. I don't think he gets through that. And so what are we going to do as Republicans in terms of who we nominate for president?
That's what we need in our country. We don't need this chaos anymore. We need someone who's going to be a new generational leader that brings sanity back to America.
GOP presidential candidates Ron DeSantis, Nikki Haley on the CNN debate stage yesterday, the two sparring with each other before finding a common enemy, former President Donald Trump, who has been missing from all Republican debates so far. All this ahead of the Iowa caucus coming up on Monday. The campaign in TK already started last year. It's going to pick up big time in the next week.
You know, we were making jokes about it earlier. We had a really, thanks to our team, and stayed up all night putting together the best quality shots to video to capture the emotion of it. But John, I find, Anne-Marie Horton has like a real day job having to put up with the pettiness of what I heard last night. You have a governor of one of our most vibrant, dynamic states. You have someone who's done public service to the nation at the United Nations under huge rhetorical pressure, different debates and that, and they're talking at each other like it's a frat party, freshman year.
Isn't that what politics has become?
It's what it's become.
Right?
That's the right word.
It was sort of like par for the course. It was unsurprising to me. Was it surprising to you?
No, it's not surprising. No, I can make a joke about it, but it's not. She can't make a joke about it. She has to live it. Joining us now, Anne-Marie Horton, Bloomberg rhetoric correspondent. Oh, I yearn for the old days. They're gone, aren't they?
Yeah, they are gone, for sure. And I think last night was a display of that. The fact that you have a Republican presidential debate without the front runner, I think Politico did a good job this morning saying this wasn't a split screen. This was a sideshow. And I'm talking about Governor Haley.
Right. Well, let's go to the main show, which is the president. We spent the last hour more on the side show with John Lieber of Eurasia Group. How did President Trump do last night?
Well, look, Iowa voters like him. Obviously, he's dominating in the polls, and you saw his ability to just talk about what he wants. He's asked about the $8 trillion he added to the deficit, and instead he goes off on tangents about how Bidenomics isn't working and how he is going to be the one that can make sure he releases America's energy independence. By the way, no one, I think has told the former president that the United States is at record production, more than 13 million barrels a day. He said he would be able to do that. It's already happening.
It's beautiful. He knows that. Democrats won't correct him. Why? They don't want to talk about it either.
They don't want to talk about the fossil fuels that they're putting out into the world. They want to talk about the electrification of the grid that they're trying to make happen. But Donald Trump has a commanding lead in Iowa. What I think is more interesting, because I'm not sure if you guys talked about it yet, was that Chris Christie, though, yesterday suspended his campaign. Obviously, it was a long shot for him to ever become president. But New Hampshire becomes much more interesting now. There was a recent University of New Hampshire CNN poll which clearly shows 2/3 of his voters will go to Governor Haley or Ambassador Haley if he was to drop out. And he had this hot mic moment, which isn't boding well for anyone, even though people I'm talking to saying, well, he's just saying the quiet part out loud. Although a hot mic, he never meant to say this. I'm not sure if you caught what he said. But he basically says, she's going to get destroyed.
Smoked. We talked about in the last hour that Ron DeSantis was somehow scared about what's to come. I think we're all assuming it's going to be Biden versus Trump. So let's talk about Biden versus Trump. That may well change, but that's the working assumption now. The president is trying to make this a choice between the former president, Donald Trump, and democracy. How successful is that going to be?
Well, it does come up in polls that people care about democracy. But at the same time, what comes up in polls time and time again is the economy. And that is why Trump continuously pivots to what he would do on the economy. He wants to make the Trump-era tax cuts in perpetuity. He wants them to be in law forever. So the economy is going to rank number one. Many people feel like they were doing better. But again, the timeline potentially is on Joe Biden's side. Inflation is coming down. All of your guests are talking about rate cuts. Potentially, people will go to the polls in November feeling better about where they stand economically and want to avoid the chaos that they felt under the Trump administration.
I can't believe we're going to have an economic domestic debate in October into the election, given the polarity on the culture wars around abortion and the border issues that both parties face. I just don't buy it's about the economy stupid. Am I wrong?
Well, the Biden campaign is going to campaign heavily on abortion. And Trump last night gave them a soundbite that they could easily put to swing states that's going to make suburban women really want to go out to the polls and vote for Biden. And that was when Trump said, for years, more than 50 years, we've been trying to get rid of Roe v. Wade. I was the one that was able to do it. I got rid of Roe v. Wade. But Trump is trying to have his cake and eat it too when it comes to abortion. A voter said she's going out to the polls to vote, go out to the caucus to vote on this. She's leaning towards Trump, but she said, I'm a bit confused, Mr. President, about where you stand on abortion. Because Trump has also tried to distance himself from states that want 6 weeks bans. He said, some women last night, he said this, don't know at 6 weeks if they're even pregnant. And he said, while I want to make sure that we can be a pro-life party, he says we also need to win elections. So he's walking a very fine line on this, but the Biden camp is certainly going to hit him on this.
And on immigration, how's that? I mean, basically, a large part of the country is saying rebuild Trump's walls that everybody was, as a generalization, huge part of the nation was appalled about, and that's shifted, right?
Well, Trump is still saying he wants to build the wall, but this is something actually Ron DeSantis and others has hit him on. He came out and said, I'm going to build a wall, and then never did it.
But now things have changed, is how I...
Well, now things have changed in the sense that potentially we might get an immigration border package before the election. And actually, even though Biden has to deal with the progressives on this who really don't want to see any changes when it comes to parole or amnesty, a border package under Biden can actually help him going into November.
John Lieber of Eurasia was talking with us on the last hour about the rest of the world watching, the consequences of this election. Let's just talk about what's happening in the Red Sea at the moment. Norman Rawls joining us later on the programme, a good friend of yours, I know. Houthi rebels launching a really complex attack in the last day or so. How's the international community responding to that?
They're very reactionary at the moment. No one has striked the Houthis within Yemen, a fragile peace agreement amongst a civil war there. But what we heard from Secretary Blinken as he's making this tour in the Middle East was yesterday, this was the quote he had to say, what I can tell you is that, as we have made clear, many other countries made clear, there'll be consequences for the Houthis' actions. So now we're waiting for those consequences, because right now it is costing companies a lot more money and time to avoid the Red Sea.
We're lucky, though, that damage hasn't been done to US military and to personnel. So let's talk about what might happen if it did happen. What if there is an accident? What's the response going to be?
Well, obviously the Pentagon will have plans of what it means to strike the Houthis within Yemen. And obviously they've been debating whether or not they were going to do that. I think people forget there are hundreds of men and women in U.S. uniforms still in Syria, still in Iraq, still in these places where it's incredibly dangerous for them right now.
I brought that up 2 days ago. Ian Bremmer has a fabulous chart of the Middle East in his Your Age Group's top risks of the year that shows the dispersion of those American troops. I had no idea. It's not like 3 or 4 things, folks. It's 5, 6, 8, 10 geographies around country.
That is why there's been so much criticism about what happened with Lloyd Austin. You go in for an elective surgery, which we now know was for prostate cancer, and at the same time you allowed your deputy to go on vacation in Puerto Rico. If you are a member of the military and you are overseas in a place like Syria or Iraq, that does not bode well.
AMH, thanks for the update. Got to turn to some lighter news in the sporting world. TK, this widely expected, this from ESPN this morning. Bill Belichick and the New England Patriots are expected to part ways today after a remarkable 24 seasons together. I'm reading the reporting directly from ESPN, Tom, ending an unmatched run in the NFL history that included 6 Super Bowl titles. This according to league sources speaking to ESPN this morning.
At the time of year, but in the last, I'm going to say 18 hours, I'm guessing, Pete Carroll of Mina Kim's Seattle Seahawks, advisor, whatever that means, Saban, you follow Alabama football.
Well, Nick Saban was a surprise to me.
Yeah.
The Alabama football program. I mean, he's getting on in years, TK. But
and now Belichick.
The guy's been dominant in the SEC. I certainly don't think this team this year is as good as teams gone by. But $11 million a year he was picking up, I think, in the Alabama football program, which is like.
But, I look at this, and the common theme here is they're all 72-ish, plus or minus 6 months. And this is a generational shift in coaching.
Yeah. Seeing a lot of that.
Yeah, we're seeing a lot of that.
From New York City this morning. Good morning. Michael Collins and PGIM coming up shortly. Equity futures, just about positive. Two hours away from the opening bell, 1 hour away from CPI data in America. The scores look like this on the S&P 500. Going into it all, equity futures positive by 0.16% on the S&P. On the NASDAQ TK, up by 0.39.
Let's do the levels right now, John. I think it's important here. On the Standard & Poor's 500, I'm sorry, as of today, I'm on the 5,000 watch. We're distant. 48.27 on SPX futures, 48.27. But John, after the gloom of the second and third of this year, I'm sorry, up 170 points in the SPX to get to 5,000 has my attention. You're on a 38,000 watch, not a record high in the Dow. And NASDAQ 100 popping back to 17,000. I believe I saw a chart. I'll give Zero Hedge credit that the Magnificent Seven sort of burst through yesterday, even if it wasn't Apple helping.
48.18 is the all-time high. 47.83 was the close in yesterday's session. So we're getting closer and closer. The next stop, the data, and then we get the earnings. The banks this morning in the pre-market shaping up as follows. JP Morgan over the year, Tom. Over the year up by something like 22.48%, which has been absolutely phenomenal.
Yeah, and this is going to go to, I'm going to give Gina Martin Adams all the love here, but there's a lot of other people with her saying there's just an underestimating of earnings, and the pulsing here of the stock market tells me maybe there's an adjustment here from mid-single digit up to top single digit as well.
Top pick JP Morgan, Erica Najarian over at UBS.
Top pick Mike Mayo,
so much
Citigroup.
of that.
I mean, everybody's got their favorite.
Looking for a big move, without a doubt. Let's turn to the bond market briefly, chop it up for you. 2-year, 10-year, 30-year, as always, going into the data, 398. Yields down by 4 or 5 basis points. Yields on the 10-year, Tom, 4 straight days, closing in and around 4%, above 4% over the last 4 days.
That's a nominal yield. That'll play off where we are in 1 hour, make it 59 minutes. But, John, I'm going to do a real yield analysis here, and there is a raging debate about what the inflation-adjusted yield does. And as Julia Coronado said, interest rates are up, and it's put a brake on all sorts of business transactions, including commercial real estate. Maybe something comes to the rescue here, as Priya Misra would suggest.
And for people maybe looking for properties in New York City, Tom, facing sky-high mortgage rates and hoping they might come down sometime soon.
But I think you said this, John, coming down one rate cut ain't going to do it.
No.
But do you get a demonstrable drop off of the inflation trend that will be reaffirmed here in 58 minutes?
TK, I was just absolutely shocked to see the numbers, the New York property sales and the composition of them. How much of it is cash? It's just shocking, amazing to see.
I think that's in a lot of cities worldwide. I mean, it's become a property investment, a sinkhole where
people of a certain age have built up a lot of equity in their homes.
Yeah.
And they've built up a big cash pile as well. Let's get some top stories under surveillance this morning. Just under an hour away from the December CPI report, Bloomberg Economics expecting the data to show inflation making progress towards the Fed's 2% goal, but still running at a pace closer to 3%. Plenty of Fed reaction to this, including New York Fed President John Williams, saying their current policy is tight enough to bring inflation down towards their goal. And he expects interest rates to come down over time. Tom, I'm interested to see the additional Fed speak today following the numbers we get a little bit later.
I'm interested in the Yardeni speak. Edward Yardeni suggests there's a few items that may give you a surprise lower, including all the housing OER and all the rest of it, rents and all, you may get a number that's a little more disinflationary than expected.
You've been itching to talk about this story all morning. This time it is real. It is not a hoax. US regulators approving the first ETFs that invest directly in Bitcoin. The SEC's landmark decision broadening access to the largest cryptocurrency in the roughly $1.7 trillion digital asset sector. The breakthrough will allow investors to buy Bitcoin as easily as stocks or mutual funds. Bitcoin ETFs expected to start trading when markets open today.
Eric Balchunas is out on Twitter. If you want to follow this, folks, follow Eric
Expert
Balchunas on Twitter, who's looking tick by tick here at 7:34 a.m. at the asset sizes. I don't understand what he's doing because I don't understand Bitcoin, but the answer is billions are involved here. And I'm absolutely shocked, John. If you see price come in, you speculate, as Raphael Auer at the BIS would say, and Bitcoin pops 47,000, up 2.7% right now. Do we close above 50,000 by this afternoon? Why not?
I don't know, but Eric is absolutely awesome, and that's something we both know. Let's finish on this story. I love this story. A great year to be a European traveller. The 2024 Henley Passport Index is out, with rankings of the most powerful passports for visa-free travel. I always ask this question, and it surprises people when they get this answer, Tom. Residents of France, Germany, Italy and Spain now have easy access to 194 of 227 destinations, 3 more than last year, and they now join Singapore and Japan, who've enjoyed the world's most powerful travel documents for the last 5 years. The UK is 4th, the US is in 7th place.
But they still have to stand in that other EU line at JFK. Have you ever looked over there? I mean, you get 4 or 5 big flights.
I mean, I'm a permanent resident in this country, Tom, so I don't have to go in that super long line in America anymore. Global entry is helpful as well, although that line has got recently too.
The backup for me in New York on global entry is so big I've never done it. But oh my word, all those advantage passport stories, and the answer is the line at JFK can get a little bit long. He's never been in that line. Michael Collins briefs now, senior portfolio manager, debt at PGIM. He watched every minute of Prudential's coverage of the Rose Bowl and the Michigan victory there a few days ago. Michael Collins, I'm going to look at the Rose Bowl here, the bond market. How will yield react off the CPI today? If we reaffirm disinflation, where across the yield curve will we see the biggest adjustment?
Yeah, Tom, Jonathan, good morning. I'm a big football fan, but I'm probably more excited about today's CPI print than I am the NFL playoff games this weekend, to be honest with you. Tells you what a bond geek I am. But I actually think the disinflation is becoming more entrenched, Jonathan and Tom, notwithstanding, the big jump in freight charges we've seen as a result of geopolitical risk. But you are seeing more evidence that things like housing are starting to unravel a little bit. I think you're seeing more evidence that the big surge in multifamily construction that is still to come online is going to cause rents to come down. So if you have housing at zero, you have goods already at zero or negative territory. Even if services and wages get stuck in the 4s, that puts average inflation in the mid-2s, right? So I think you're on that trajectory. And I think the Fed is ultimately going to have to play catch-up.
So do you model out, I haven't asked this question in ages, but I agree with you, and more importantly, Ed Yardeni agrees with you on the surprises we may see in housing disinflation. What does that do to the 2-10 vanilla yield curve? I mean, right now we've been inverted since time began, and what do we do? How does that react off of today's report?
Yeah, I mean, the playbook, as you know, Tom, is that the curve, bull steepens. The front end rallies more than the rest of the curve. That's, I think, what's in the cards over the intermediate term, meaning over the next year or two. In the next few months, though, if you're looking to trade this, I mean, it's really tough to be long kind of that, 2 and 3 and 4 year part of the curve, because as you know, there are a lot of rate cuts that are priced in the near term, starting as early as in 2 months from now, that may not come to fruition. I mean, the Fed is good at waiting and watching and lagging, right? They lagged on the way up, and they are probably going to wait too long and keep rates too high for too long before they cut, and then they're going to have to cut more aggressively. So I think that's really the timing of what's going to happen. But ultimately, in 2 years from now, I think the curve will resume a more normal upward sloping shape.
Michael, this is a little bit of a subtle shift from you. I've been following you for a long, long time. You know that. You haven't been super bearish, anything but. You've been constructive on certain parts of credit. I've noticed you've lightened up recently on credit exposure. Michael, can you tell us just exactly why and what's changed over the last few months? Is it price? Is it fundamentals? What is it?
You know, it's more price than fundamentals, right? If you look at the fundamentals, I mean, the economy is actually doing great. It continues to surprise in terms of its resilience. I mean, it seems like the whole soft landing is happening, right? I mean, if you do have a recession, and we have a 25% recession probability, which is elevated relative to, historical averages, but it's not going to be a hard landing, right? The probability of like this big, existential credit crisis where defaults spike and, consumers default and businesses go out is really, really low. You just don't have the leverage in the private sector to cause that impetus, right? So I think that bodes well for fundamentals. I mean, but credit fundamentals are deteriorating on the margin. They are definitely not improving, but it's really the price, Jonathan. I mean, if you look at what's happened with credit spreads, they snapped in dramatically through the end of last year, along with rates rallying, along with volatility coming down, along with stocks going up, and they're kind of getting to the low end of their historical ranges in an environment where there's still a ton of economic and geopolitical uncertainty. So I think it's more, be patient here, take some chips off the table, wait for better opportunities to reload on credit.
So does that mean clip the coupon as a general statement after a fairly robust 2023?
Yeah, I think you clip the coupon in fixed income, and I think you're still earning attractive yields. I think interest rates across all sectors of fixed income are going to be lower in a couple of years from now than they are today. So I think you clip the coupon for now. Look for opportunities. If rates back up, you buy them. If credit spreads widen, you buy them. I think that's the world we're in. You have this Fed backstop, which you haven't had in a long time.
With immense respect for PGIM and all the awards you've won for total return, how do you and the team there frame the debacle of the last 3 years? Do you frame that someday we'll get back to where the Bloomberg Total Return Index was in bond, that we will see true appreciation, or is that a time long gone?
No, we're back right to where we were 20 years ago, Tom. We look at beginning yields, and the big index everybody in fixed income uses is your Bloomberg Aggregate Bond Index, which is yielding 4.6%. And we are trying to beat that, right, by 1% to 2%. So if you just kind of do that simple math, you're looking at mid plus single digit type of expected returns in high quality, diversified fixed income, over the next 5 or 10 years, right? That's the beginning yield on high quality fixed income is a really good predictor of ultimate return. So the last 10 years it really has been the lost decade in fixed income. It's been more than 2 or 3. It's been returns in the really low single digits. But that's behind us, right? The forward-looking view on fixed income is much more constructive.
Michael Collins, you are one of the absolute best over at PGIM. I love catching up with you. Mike Collins there at PGIM. Thanks for being with us, sir. Appreciate it. If you are just joining us, welcome to the programme. CPI just around the corner. Equity futures on the S&P 500 look like this coming into that. We're positive by 0.17%. Breaking news just moments ago. Another EV reality check. This time from the car rental company Hertz to sell about 20,000 electric vehicles from its US fleet, 20,000, and to reinvest a portion of proceeds into internal combustion engine vehicles. And Tom, the action to better balance supply versus expected EV demand. That is another big reality check for this push.
I'm not up to speed on what this means, but my operative word is massive. This is a massive signal from Mother Hertz. And I love what they do within the press release. They say ice. I'm like, I have no idea what ice is. I'm thinking of vanilla. And the answer, John, as you say, we're getting out of EV and we're going back to old technology. And I'm certain within their analysis and the sell side at work, it's going to be because their customers told them.
Precisely. They've got to slow down. Now, if you speak to the automakers about this, they'll talk about a change in execution, not strategy. Seems to me that's the same approach from Hertz this morning, Tom, because when you look at the 20,000, that deal represents about 1/3 of the global EV fleet. They're trying to do too much too soon relative to the demand that exists right now. Hertz is experiencing that. Other automakers are experiencing that to some degree as well. We've seen headline after headline, Tom, speaking to the same theme.
Ian Bremmer out with a beautiful chart today on the minerals that China dominates in, and they dominate in battery technology because they've got the raw materials. Some of them I couldn't pronounce. I'm not sure what they were. But
you get to the airport, Tom, you rent a car, right? You're in a new state, a new city, you're not sure where you're going. You don't know where the chargers are.
Usually they're out
You've got
of
that anxiety. You're getting an internal combustion engine car, aren't you? Isn't that the preference?
I do like internal combustion.
From New York City, this is Bloomberg.
There are lots of danger points. We're trying to deal with each of them. We want to make sure, through diplomacy, that we can create enough security and a strong sense of security so that people in Israel who've been forced from their homes can move back. People in southern Lebanon who've been forced from their homes can move back. I think no one wants to see escalation there. Israel doesn't. Lebanon doesn't. I actually don't think Hezbollah does. So we're working on that.
Happening just moments ago, that was US Secretary of State Antony Blinken speaking in Cairo to reporters on the latest developments in Middle East tensions. TK, that intense period of diplomacy for the Secretary of State has been non-stop, hasn't it, since early October?
Non-stop and multi-front, and certainly the conversations we've had here in surveillance have not been centered just on Gaza and the horror that we see in Gaza, but it rolls right over to the eastern side of the West Bank and on up to Hezbollah. And then all of a sudden, you got a fourth front, I'm going to call it, in the Red Sea as well. And John, is it hour by hour? No, but it's half day by half day, definitely. The news flow is
the news yesterday was extraordinary, Tom, that we've got US forces and allies shooting down 18 drones and a barrage of missiles aimed at these merchant shipping lanes. Tom, accidents can happen, and we're fortunate that accidents haven't happened, and that so far the US and its allies have been successful to some extent. Is it acting as a deterrent to stop them? No, it hasn't worked at all to that extent, Tom, because the likes of AP and Moller-Maersk, as we know, the big container shipping giants, the merchant ships, Tom, are not using the Red Sea as they were a month or so ago.
Let's have a delicate conversation on this right now, and it's a conversation of geography and technology. Norman Rule, Senior Non-Resident Advisor for Transnational Threats Project at CSIS, and working for America as a former senior U.S. intelligence official. Norman, I got 8 ways to go, but when I look through the literature and the zeitgeist, it's not like from Butch Cassidy, who are these guys? It's more, where are these guys? Where are the drones coming from? Where are the Houthi established geographically as they attack ships in the Red Sea?
Good morning. Houthi forces and control is generally in the western portion of Yemen, which focuses on the Red Sea and the Gulf of Aden. There are not only missiles, drones, explosive boats, and mine capabilities that must be monitored, but some of these capabilities are mobile. Missile launchers are mobile. Drone sites can be trucks or barren fields. So this requires intensive and dynamic intelligence collection if one is to look at targeting these facilities for military action.
Do we do this alone, or do we collect intelligence, particularly with the Houthis' great adversary, Saudi Arabia?
The nature of U.S. intelligence collection for military operations in this scenario would likely be done by U.S. and British and allied forces who would be involved in any potential kinetic action. The Saudis would not be playing a role in kinetic action, so their involvement would be limited, if any.
Norman, this is causing a massive disruption. I'm just wondering how cheap it is to cause this disruption. How sophisticated is the military arsenal of, say, the Houthi rebels? How sophisticated, how cheap is it?
the military capabilities of the Houthis are relatively sophisticated in terms of missiles, but this is an older technology. Iran has provided it. Iran has provided the training in Yemen and in Iran itself. And in essence, when the military tends to look at these targets, there is the issue of a missile that costs so many thousands of dollars or a drone so many tens of dollars versus a $2 million anti-ballistic missile. But the idea of, well, what damage could that drone or Houthi missile cause really becomes part of that economic equation.
Norman, US forces and allies, the mere presence in the Red Sea is meant to act as a deterrent. It's not. They're now intercepting missiles. What happens if they fail to intercept one of those missiles? Have we given thought, Norman, I'm sure you have, as to what would happen next as a consequence?
So I think it is fair to say that the U.S. and partner presence, to include the United Kingdom, has shaped Houthi behavior and likely deterred some scale of their action. This said, if a Houthi missile were to strike, say, the bridge of a container ship, and it were to sit in flames in the Gulf, or to strike the bridge of a tanker, or worse yet, to cause significant damage on an oil tanker, that would be dramatic. A significant oil leak in the Red Sea would shut down all shipping.
I mean, a really naive question, Norman, but I've got to go there. So a drone goes up in the air, and does a pro like you go, oh, we'll knock it down? I mean, is it like skeet shooting on a Sunday, or, you know, the clay pigeon's up there and you just nail that puppy? Or is it sort of blind luck-ish that we're knocking down these drones? Which is it?
Well, I'm not a pro and I've not been involved in those angles, but it is not blind luck. This involves precision weaponry and a tremendous amount of training, and our NAVCENT and CENTCOM personnel go through a tremendous amount of training for this sort of event throughout the year. So when we bring this forward, and let's take it back to the Secretary of State doing shuttle diplomacy, who does he want to talk to have a change agent for the Houthis? Does the Secretary need to go to Tehran and begin a dialogue with people that we don't want to have a dialogue with? Such a dialogue, which would be unadvised, injudicious, would have no impact on Iran's behavior. Iran's proxies throughout the region are following a consistent pattern of aggression against the United States and Israel. The United States does send messages indirectly to Iran through a variety of partners, people who have diplomatic relations with Tehran, but it has no effect, and it's not anticipated to have any impact.
Norman, ultimately what we're getting at here is what is the risk, the potential that this war could spread? As we know in the last week, and you and I talked about it, top Hamas official killed in Lebanon. That potentially was a source of escalation. It hasn't been so far. How do you think that is contained at the moment? How contained is the risk of a broader conflict?
Well, there continue to be no strategic drivers for Iran or its proxies to engage in a conventional conflict or risk a wide-range formal conflict, because that threatens many of their domestic political and economic initiatives. At the same time, there are multiple reasons for Iran and its proxies to maintain the current level of violence and even escalate that level of violence as they've crossed red lines and some of the violence is normal. Norman, one final question, and we are thrilled with your commitment to surveillance. You've really come on since day one here and given us perspective. This seems to be deteriorating. Away from the media coverage, the immediacy of images in Gaza and all, is that correct in Washington among institutions, including your CIA? Is this a deteriorating situation? I would say it's an evolving situation, and it's evolving somewhat predictably. In the absence of deterrent action against Iran and its proxies, they're continuing to maintain some sort of an approach to upset the regional security. Here's your worry. If we undertake a two-state solution diplomatic effort, do we expect Iran and its proxies to stand by while Palestinian relations with Israel are normalized? That's unlikely. So I don't see that there's been sufficient diplomatic effort by the international community to say, how do we constrain Iran and its proxies from upsetting peace in the region?
So true. Norman, thank you, sir, for your input this morning. Norman Rule there of CSIS, a former senior US intelligence official. TK, crude this morning, 72.82. Crude actually higher this morning by 2%. On Brent crude, 78.25, up by 1.9%.
You wonder what the energy stocks will do off the Hertz announcement. I mean, there's the geopolitics and Brent crude running off that. But, I don't take lightly this write down. couch it in the phrase depreciating accounting, but this write-down of EV against all the ESG change of tone you're going to see in Davos. I mean, I know you were going to do an entire hour devoted to ESG in Davos, and you couldn't find three people to line up.
Is that what you were assigning me?
I remember being there. Savita Subramanian at Bank
Savita
of
was
America,
great. Yes, she was great.
Who owned the high ground on this and still does in terms of very careful adult math. That's away from the branding, the blather, and here you are, Hertz, thrown in the towel before Davos.
Kind of. Just incrementally pulling back, not completely throwing in the towel. So we're talking about 20,000 EVs, but I agree with you, Tom. It's a really important story. Just to share some numbers with you, 11% of the total fleet was EVs, 80% of that Teslas. So you're going to get a fair amount of Teslas hitting the car market, Tom.
If I get a Tesla, folks, seriously, on Lyft or Uber, I have to cancel it.
Oh, you don't fit?
I can't get in it. I mean,
I think that's a unique problem.
The first time
I think that's a
was
unique
in a Tesla,
problem, sure.
I was going beneath 59th Street, and I'm driving the whole way like this.
I'd be nervous about buying an EV.
Help me get up.
I'd be nervous about buying an EV in the second-hand car market. Wouldn't you? Wouldn't you want the warranty?
Yes.
From the manufacturer?
Yeah.
I'd be a little bit nervous about that. Linda Dussel of Federated Hermes coming up next. In the next hour, CPI in America, 8:30 Eastern Time. Equity futures positive here on the S&P 500, up by 0.1%.
Right now, the consumer is starting to feel a little bit better. Inflation is going to continue to come down.
I think inflation is going to keep trending lower.
It's fair to say data dependency will continue to be key.
As long as the labour market is holding up as strong as it is, then I think consumer discretionary can do well.
Until we see a slowdown in labor market, the consumer can continue to run here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bramo on assignment this morning in this important half hour, a measurement of your inflation across America. We'll have that for you at 8:30 with Michael McKee. Its ramifications in the market. Linda Dussel will join us from Federated on why you're not in the stock market. And you got to believe, John, the economic reports and what we see from the banks tomorrow folds right in to the equity tone.
Yeah, two-part story. 1-2 punch for this market over the next 24 hours. Data this morning and then earnings tomorrow. CPI a little bit later, together with initial jobless claims. Then bank earnings, JP Morgan leading the pack tomorrow morning. Looking forward to covering all of that with you. For the Federal Reserve, what do the CPI numbers mean for them? And Tom, is much too soon to consider easing policy and reducing interest rates?
It's interesting to see. I didn't see the note, but I know Goldman Sachs is republishing HOTCS about March, June, and all that. And I guess that gets readjusted here at 8:30 and then gets readjusted with Michael McKee's conversation with Loretta Mester of Cleveland, where she'll give the tea leaves out. Like, did you see the headlines off Williams yesterday?
Yeah, sure.
Well, I sort of kind of think like this, and come on. It's about the economic data. They're data dependent, and you're going to be dependent for 26 minutes here, 29 minutes, excuse me, here.
I'll share a quote with you, shall I?
Yeah.
As inflation comes down over time, my expectation is interest rates will also come down over time.
There we go.
The timing of when that happens and the speed at which that happens will depend on how inflation evolves and how the economy evolves. So helpful. We're going to find out how inflation evolves in about 28 minutes.
If I said that on air, the audience and you would put me in the timeout chair.
They'd go to sleep.
Wait,
no
I was
doubt
already
about
in
it.
the timeout chair.
No doubt about it. CPI a little bit later. We also need to talk about Hertz. This story is fascinating.
Yeah.
20,000 EVs are going to be sold by Hertz. We saw some subtle signs of this back in October when we heard from the CEO. What's interesting about this, Tom, is not just about demand. It's also about the cost of carrying these cars at a company like Hertz. So on demand, this is what they've got to say. The company expects to reinvest a portion of the proceeds from the sale of EVs into the purchase of internal combustion engine vehicles to meet customer demand. The company expects this action to better balance supply against expected demand of EVs. But earlier last year, late last year, Tom, the CEO was talking about the cost of carrying EVs, higher repair costs compared to the rest of their cars.
Yeah.
That's what a lot of people are going to find out.
I don't want. And good morning, Mr. Musk. I know you watch every morning, but I'm not going to pick on Tesla here about EVs in general. I think there is a real worry here about the repairs. But you nailed it, John. With what are we talking about here? Let's sum together before we get to Linda, do the data check as well. What are we talking about within the blather of early January? What we're talking about, and Julia Coronado nailed it, and John Ferro nailed this, is the cost of carry. And when you go to Happy Valley this week at Davos, that's a difference in this year's Davos.
Without a doubt.
All of a sudden, there's a finance rate for everything the great and worthy want to do.
This is the distinction, Tom, between speed and destination. The crew at Davos at the World Economic Forum are going to talk up the destination. They're going to get everyone to say, yes, this is where we need to end up. And then they're aggressively going to push the speed, how quickly you get there. But we've seen reality check after reality check from companies and from consumers as well, Tom, as to how fast we can actually get there. And I think what this is about, it's not a change of destination yet. I don't know if that destination will ultimately change. The objectives haven't shifted, but the speed at which you're going to achieve them, clearly, this is another reality check.
I'll go Davos on you. It's about the journey and the real yield.
You're going to hear a lot
as
of that.
well. Linda Dissel in moments. Just moments ago, Craig Trudell of Detroit will join us on ICE here. I love that.
Internal
ICE.
combustion engines. Okay, looking forward to that. A little bit later this hour, 8:45 Eastern Time. TK, the scores look like this on the S&P, positive by 0.1%. Just a little lift here going into the data. Yields are lower, TK, down by 4 basis points, 398.85.
Without question, the most important interview of the day, the conversation of the day on your courage to be in the equity markets. Linda Dissel, senior equity strategist at Federated Hermes. With all the troops at Federated, there's been a lot of experience in cycles. Linda, what did the team do at Federated on January 2nd and 3rd when the world collapsed for the Magnificent Seven?
Well, we like the Magnificent Seven, but we feel pretty good about the year ahead because we're looking for broadening. And I'm sure lots of people are talking about broadening of this market. You know, last year was the easy year. Last year we had lots of easy money and we were spending it. And profit margins are what really surprised all the naysayers last year. This year should be harder, but which way are we going? Are we going into a recession now, or did we have a rolling recession already? And you know what? It doesn't even really matter, because if we go into recession, our dividend stocks are extremely cheap. Nobody's been looking at them for years. And if we're not going into recession, then the early cycle stuff, that's that small cap, particularly growth stocks, and those financial stocks are really inexpensive. They've been hit hard, 50%.
You and I you don't remember this. Unfortunately, Steve Auth and I do remember 1977, where we came out of the horrific 75 first bull market leg, and then surprise in 77, there was that second leg nobody saw coming. How do you have a second leg of a bull market? Is it at the revenue line?
Well, it's the revenue line will be more challenged. And it's interesting that you bring up the 70s, because in the 70s, you had an inflationary problem. That's good news for the top line until it starts to really eat at your expenses, and then it hurts your bottom line. And that's what we're looking at this time. Are we repeating the 70s, where we claim victory too soon, where the Fed maybe cuts too soon, but actually companies are having a harder time with their margins because they don't have that top line growth that they did when there was strong inflation. So good news, it's coming down. But what about those wages that keep going up, 4 and 5% a year? That's where we have to watch the margins. And that's what we're really going to be listening for in the earnings season.
Let's get into it. Defending those margins, Linda. Who's doing a good job of that right now?
That's going to be a stock picker's question as to who does the best. And I think this is where, as you were talking about, where we're going, our destination, and how fast we get there. How fast can companies incorporate the benefits of artificial intelligence to help their productivity to advance? So I think this is going to be much more of a stock picker's market. It's not necessarily in sectors, which is why you can't throw the baby out with the bathwater. Interestingly, when we talk about small cap stocks, particularly in the growth area being inexpensive, people want to know which ones are the profitable small cap stocks. They are historically inexpensive. You have to go all the way back to 2000 to see them being this inexpensive. So that's where you have to really, roll up your sleeves, and do your work on this, on the individual names.
We're dancing around the elephant in the room. We're talking about defending margins, AI adoption. Linda, aren't we just talking about job cuts here? And given where claims are at the moment, at 2:02, we get an update in about 12 minutes time, 22 minutes time. Linda, where do you expect claims unemployment to be as we close out this year, given what you've just suggested?
Well, I don't think we should blame AI for job cuts. I think if you're worried about losing your job to AI, you should worry about losing your job to someone who understands how AI can help your company and their profit margins. But as we look at the employment situation, and we're at a near record low or record low on the unemployment rate, it's hard to really imagine that gets too much worse when the labor market is so very tight. But what we're going to watch there is something that has been termed the rich session, where people making $125,000 or more, those people that are being labor hoarded by companies who pay much more for them than they would have just 3 years ago, are having to cut costs because of a margin problem. And then we see that maybe rolling across the economy or across industries.
Linda, I am absolutely fascinated by your comment at the beginning on dividend growth. And what I find interesting about use of cash analysis right now is nobody's talking about it. That has all my radar up. Why aren't we going to just see a continuation of use of cash, of dividend increase, and far more importantly, share buyback? People seem to like that.
Oh, yes, sure. People like the buybacks. They like the dividends. People who want to have income are looking for income sources, and that's where dividend plays work. They're also looking for inexpensive stocks, and that's where dividend plays work, because who needs dividend stocks, or who has needed them in the past few years when the FANG stocks, magnificent stocks were all the rage, when people think that Microsoft is your bank? And who needed it necessarily when you could get money market rates over 5%. But guess what? If they start cutting interest rates, if the Fed starts cutting interest rates, that whatever $9-10 trillion that we have in money market funds, though we love them at Federated Hermes, will say, I don't know if maybe I want to find income at least in a more diversified way. And they will find that income in the beleaguered, nobody cares about, still fine fundamentals, dividend plays.
What do you do with the big banks? We, I believe, have a banking day tomorrow, folks. We've got a lot of good coverage centered on Sonali Basak on that. JP Morgan, Citigroup, and the rest. Are they the ones to buy, or do you buy the value or value trap that's smaller banks?
Well, that's a really interesting question and important question. We're overweight at Federated Hermes on the financial sector, so we do like them. We agree that they're incredibly cheap. And as I've been watching your program before my time to come on, I saw your banking analyst pick JP Morgan as the #1 pick. That is a conservative pick. And so the chasm between the regional banks and the big money center banks is really, really wide. There again, an analyst can say, I don't need to throw the baby out with the bathwater. I can study these companies. I can find excellent regional banks that are unbelievably cheap and maybe even single-digit PE ratios. And that will be the important broadening that will give us a good, strong year this year.
At times last year, that gap got even bigger. Linda, thank you. It's good to hear from you. Linda Dissel there of Federated Hermes. TK, that analyst, Erica Najarian, UBS, looking for a rocky time for some of the banking sector later this year, and looking at JP Morgan for defense. That's
what we do. We're trying to get you sell-side analysts like Ms. Najarian and Mr. Cassidy over at RBC, and I love Linda Dissel there. Very much like Megan was at Graper at Barclays yesterday.
Oh, she was awesome.
These are like grizzled pros folks taking a belief amid the cacophony of news flow right now. You may not agree with the belief, but boy, you listen to them to frame out why Linda Dissel has that view of optimism on the market.
We are 18 minutes away from inflation data in America. It is just around the corner. If you are just joining us, welcome to the program on TV and radio. This is Bloomberg Surveillance, and your equity market is positive by 0.15%. Yields are lower by 4 basis points, 398.66. It's EK. We're going to catch up with Dana Peterson of the Conference Board, reacting to the CPI data following those numbers. Mike McKee's going to break it down for us. We need to talk about the threat of higher inflation in our future as well, and a source for that potentially from the shipping problems in the Red Sea. We'll catch up with Bloomberg Intelligence in a couple of minutes' time.
Yeah, Lee Klasko to come up with this as well, and he's truly world-class on this. I'm not quite sure how boats in the Red Sea fold over to tractor-trailers on I-80 going out past Iowa, but the idea of logistics and transportation being upset as a wild card for this year.
Have you seen the move in AP Moller-Maersk? 2 months, 30%. They're looking for higher prices, potentially. That's what this market is here in TK. That's what the reaction is in the stock price. Are we going to see that in the kind of numbers we'll be looking at CPI? Not this time at 8:30, but maybe a few months down the road.
Well, yeah, it's a hockey stick up off the huge depreciation last year. But again, maybe that comes up to something we haven't talked about all day, which is China. I mean, I wonder how shipping folds into a misguess on a better than good China. That's not consensus, but it's out there. It's something people are talking about.
Lee Klasko of Bloomberg Intelligence coming up next on shipping stocks, absolutely surging in the past few months. In your equity market on the S&P 500, positive here by 0.15%. The data is just around the corner. CPI in America with a bond market, a yield on a 10-year around 4%, 398.66. Yield to lower by 4 basis points from New York City. This is Bloomberg.
Right now, the consumer is starting to feel a little bit better. Inflation is going to continue to come down. Wages and incomes are still rising. So there's a lot that is positive for households, and it's a lot that is positive for businesses because interest rates are going to go down. So we do think that there is a chance that there will be upside surprises in the economy.
That is the very positive view, the outlook on the economy. Rabila Faruqi there, chief US economist at High Frequency Economics. Inflation data, the next stop, a catalyst for conversation in about 15 minutes time. That is just around the corner in America. The price action, the scores going into it, shaping up as follows. Pretty muted on equities, positive by 0.16% on the S&P. Yields are a little bit lower, down by 4 basis points, but still around 4%, Tom. 398.66.
In the old days, John, let's get right to this, folks, because this is too valuable for you, on transportation and logistics. In the old days, John, we had paper sell-side reports. There wasn't the internet, there wasn't PDF files. And you would look at a Prudential report from Lee Klasko and you'd say, wow, does he know what he's talking about? This guy has devoted 30 years plus to the idea of logistics in America, and all of a sudden he's an expert on the Red Sea as well. Lee Klasko, senior logistics analyst for Bloomberg Intelligence. ABN AMRO years ago, Prudential, the blue and white, to be like, wow, this guy knows what he's talking about. What's the distinction, Lee, that's not in the media right now on this Red Sea mess? In logistics, what's the thing you need to tell people?
Well, I think that most people should take to heart that this is probably a short-term phenomena and not a long-term structural change to rates. It's obviously been very disruptive to supply chains as ships have to bypass the Suez Canal and go around Africa. That adds 10 to 12 days, and that is absorbing a lot of excess capacity that's in the marketplace. The amount of capacity that's probably was the loosest was the container liner industry, and you're seeing, really the best, increase in rates in that market. Since they bottomed in mid-October, they're up around 165%. And so that's a pretty high number, but people have to also remember, yes, it may be a little inflationary, but rates are down about 70 to 80% since their highs during the pandemic.
Right.
And they were depressed before. Even though rates have gone up considerably, companies like Maersk or Zim or Hapag-Lloyd, they may not make money in the first quarter, even with the high rates. Because the rates are higher, but they're just starting to move above break-even levels for a lot of these carriers.
Lee, we talked to you a number of times during the pandemic when this was nuts, including imports into California from Asia and all the upset of China and the Pacific Rim. Are we back to normal?
When it comes to the North American supply chain, I think we are very close to normal. I think the rails have to do a little better when it comes to service. They've made some drastic improvements since the onset of the pandemic when they were caught flat-footed and they furloughed way too many people, and it took a long time for them to rehire those folks back because a lot of them did not want to come back to work. But outside of that, I think we are back to normal. I think the trucking market There's a lot of capacity out there, and that is keeping truckload rates pretty depressed. But one of the knock-on effects of the Red Sea, at least when it comes to North America, is we could see an increase of traffic coming into the West Coast because the East Coast is just either too expensive or taking too long, and then railroads will ship freight or containers from the port of LA or Long Beach or Port of Prince Rupert up in Canada to the population centers in the East. And that would benefit like the Union Pacifics, the Burlington Northerns, and also the intermodal providers like J.B. Hunt and Schneider.
Lee, as you know, that's not just because of what's happening in the Red Sea and potentially the Suez Canal. It's the Panama Canal as well. The water levels are pretty low. Lee, I'm just wondering how busy those rails are going to be over the next few months and how busy the West Coast is going to be, given that too.
Yeah, I mean, what's going on both canals has obviously been extremely disruptive. In the Panama Canal, as you mentioned, when that comes to a conclusion, that's in my mind a bigger unknown because we don't know when Mother Nature is going to, bless the region with rain. So what that is limiting is the number of ships that can go through the Panama Canal and actually how much freight a particular ship can carry because of the limits on the levels of the water. And so that is also changing the way people are shipping things. There maybe instead of going through the Panama Canal, for delivery into the Gulf or the southeastern United States, maybe they're moving stuff again into the West Coast ports, which would be really good for the West Coast ports because they've lost market share during the pandemic when congestion was at its highest. So you could see them starting to win back some of that share. And one of the other railroads, Canadian Pacific, Kansas City. Now, they own a railroad that is a land bridge in Panama, and, they're probably benefiting incrementally from the lower water levels as shippers are looking maybe to use that land bridge to move the containers from the Pacific to the Atlantic.
This speaks to what Tom asked you, and I think we have to put these two stories together. Are you comfortable with the capacity that we have on the West Coast to deal with this?
Yeah, I think we're not nearly where we were during the pandemic. What really will depend is how long the issues in the Suez Canal last, because it's changing the schedules. So when a ship was expected to come 7 days and everyone's prepared for it to come in 7 days, and if that's all of a sudden 14 days. You have to readjust the schedules. Mm-hmm. So you might see some ships waiting a little bit, but you're not going to see the craziness that we saw when there were over 100 ships, outside of LA, Long Beach, waiting just to dock to unload their freight. But it definitely will be a little disruptive. And hey, if this ends in a couple of months, I think it'll be more or less a flash in the pan.
Lee, off topic, but critical over your 30 years of excellence. When we look at the revolution of logistics in our delivery, FedEx, Amazon, and the rest of it, we had a next day experiment. Is next day shipping sort of done because it proved to be a lot harder to do than we expected?
I don't think so. I think it's a premium product, and therefore it probably deserves a premium price. If you really need that Amazon order to come the next day, you might be willing to pay for it. Or if you're looking for, somebody that maybe is not on Amazon, if you're looking for that next day, you're willing to pay for it. But I think what we're seeing is consumers are more willing to say, well, I don't need it tomorrow. I can wait 3 days. And that is something that we're seeing in the numbers for FedEx and UPS. When they report, you see a negative mix shift to, more economic services which carry lower fees and therefore reduces their overall revenue per shipment. So I think that, it's not over, but it's maybe it's really going to be pigeonholed to be more of a premium as opposed to the norm. I just wanted to squeeze this in. You alluded to it earlier in the conversation. Just quickly, how durable are these tailwinds? We've seen these big stock moves in the last 2 months, particularly on the likes of AP, Moller Maersk. Do you think this is durable? No, because the reality is that, listen, I don't know when the Red Sea crisis is going to end. It really depends on the coalition and how active they go after the Houthis. It doesn't seem like they've done much so far. They need to do a lot more. That being said, once it does come to an end, there are structural issues within the container liner market. Supply growth is supposed to outpace demand growth by a significant margin over the next 2 years. And that's going to bring rates back to those depressed levels that we saw, maybe not in mid-October, but much lower levels than we saw today. It's a little different for the tanker and the dry bulk market. Those supply-demand fundamentals are in much better shape.
Lee, this was awesome. Let's do this again soon. Lee Klasko there of Bloomberg Intelligence. I can tell you, Tom, if the Federal Reserve wanted to be short one story right now, it's this one right here. This is not one that they want to stick around.
Long ago and far away, Kenneth Rogoff said to me quietly, off mic, off camera, there's a huge underestimation of the ease of our logistics, our modern logistics. Sometimes I get a DHL from Europe faster than I do from Dallas. What is that about?
It's kind of strange, isn't it?
It's kind of strange.
I know.
But we take it for granted. And the answer is right now, we do not with our military in harm's way in the Red Sea.
Without a doubt. We don't take Mike McKee for granted. I can see him at the corner of my eye. He's here to break down inflation data. CPI in America up next. Bond yields lower by 5 basis points, 398. Equities positive. Your data is just around the corner. The inflation data in America about 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.2%. A little lift in this equity market. In the bond market, we are rallying. We're down 3 or 4 basis points on a 2-year to 432. On a 10-year yield, we are lower by 5 basis points to about 398. With the economic data, CPI in America, here's Michael McKee.
Well, it looks like we had a little hotter than we expected. Inflation during the month of December up 0.3%. The forecast was for a 0.2 gain, pushes the year-over-year number up to 3.4% from 3.1% in November. That's not what the Fed or the markets want to see. However, the core rate comes in at 0.3 as expected, which pushes down the year-over-year core number to 3.9% from 4%. So it's basically what we're seeing here is a little bit worse headline and as expected core, and the core is going to matter more than anything else. Index for shelter is what the BLS says contributed most of the rise in December. Energy rose, increases in the electricity index and the gasoline index, which is a bit of a surprise. So I'll look at the rest of this breakdown here, guys, and you can look at whether the market is freaking out over this.
We've got a move, not a freak out. We're negative by, let's call it 0.10% on the S&P 500, 0.1% on the S&P. We're negative on the NASDAQ by, let's say, 0.03%. But the bottom line is we are off the highs of the session. Similar move in the bond market. So yields were lower. Now they're higher at the front end by 2 basis points to 438. In foreign exchange, the euro turning around. The euro was positive against the dollar. That currency pair is now negative by 0.15%. 109.56 on the euro against the dollar. Mike McKee, it's not just CPI. Got to say jobless claims.
Jobless claims, they continue to be what they were, 202,000. That is down 1,000 from the revised 203 the week before. But at this point, we're still dealing with holiday weeks and holiday adjustments, and that's always an issue. So it does tell you that the labor market is still tight, but we can't put a lot of faith in the exact number. Continuing claims, 1,834,000. That's down from 1,868,000. So a tight labor market.
Yeah.
Headline prices up a little bit. Core prices on a year-over-year basis going down.
I wish you could see McKee as he plows through this data, folks. It's years and years of experience. Mike, I'm not doing that. I got the cliff notes here. And the answer is I'm seeing an owner's equivalent rent, blah, 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 month over month, numbers you follow, up 6.3% year over year. Now, we'll have that come out here in a couple hours and see what housing is doing, rental, and all the rest. But are we underestimating that if there's already rates coming down, that maybe there's a rekindling housing boom out there? Is that an uncertainty?
There has been a suggestion that that could be happening, but that would be too early to get into the CPI right now. It wouldn't show up. We have seen ongoing strength in rents, which has been a reason for seeing ongoing strength in the housing numbers. But at this point, it's more just the fact that housing prices have not moved down very quickly. Here's the rent number. Rent of shelter up 0.3. Up at this point 0.4 after 0.3 the prior month. So rent of shelter, rent goes up, and then owner's equivalent rent is up 0.4 after is up rather 0.5. I knew it was 0.5. I said 4. I don't know why. After 0.4. So we saw the housing numbers go up, and that did not help. Yeah, I'm feeling I'm under
Hey,
your
Mike,
spell
I'm with you.
here.
It's like it's January 11th, and it feels like the longest month ever already.
John Ferro, are you surprised at the lack of movement in the bond market? I'm sort of surprised by that.
Not really. It's all incremental stuff. I'm not sure whether this is really going to shift the debate for the Federal Reserve, Mike McKee. You're going to catch up with the Redemester a little bit later.
The interesting thing is last week we had a very similar result in Europe, where the headline went up and the core went down, and when that happened, European markets, futures markets, sort of freaked out a little bit and took away a number of rate cuts and pushed back the timing of rate cuts for the ECB. Some of that's come back now, but it looks like U.S. futures traders have learned a lesson.
You can ask Loretta Mester if she retires from Cleveland, is she going to become a football coach in the NFL? There's a lot of vacancies.
A lot of vacancies in the
NFL.
There's also a big one in Alabama. So if she's looking for some warmer weather, but she's originally from Philadelphia, and well, we'll see.
And $11 million, Mike McKee, like real money to go and coach Bama.
Yeah, 11 million or so a year. I don't think people will get 11 million because that was a guy who won 7 national championships. But figure that into the Atlanta Fed wage tracker.
Football coach inflation that we see.
This is the job changers part where we see if you get more money for changing your job.
Stay with Mike McKee through the morning on Bloomberg Radio and Bloomberg Television. He'll go beneath the headline data, really important stuff. I'm looking, first read for me will be David Rosenberg up in Toronto. We'll see what he says as well. Right now, Dana Peterson joins us, chief economist at the Conference Board. To the heritage of the Conference Board, Dana, is there inflation that will affect corporations in this report, or what your guesstimate is for tomorrow's PPI?
Well, CEOs are already complaining about inflation. They're saying the cost of doing business is higher, from wage increases to higher interest rates. All of it's really weighing on CEOs right now. So I think some of this probably will feed through to the CPI and the PCE over time.
What will it do to Fed policy? I mean, it's an unfair question. Mike's only on page 6 of a 42-page report. But Dana Peterson, do you see enough of a movement here to adjust the parlor game of March and beyond to June?
Well, we think that the Fed probably won't start cutting rates until around June. And the key thing will be the course of inflation. The good news is that core inflation is still slowing, but the Fed also cares about the headline. And certainly when we look in the core, if home prices are still rising month on month, that doesn't bode well for year on year. But the good news is that we are seeing some cooling in wage inflation overall. And when you look at home prices, or at least the existing home prices year on year, they're slowing, and that's showing up certainly in the rental components of both the CPI and the PCE.
Dana, can we get a little bit more detail there? Just how high or low is the bar, do you think, to reduce interest rates at the Federal Reserve? And is it because you think it takes longer to get to that bar, or ultimately it's a bit higher than this market thinks it is?
Well, I think the bar really is inflation, but it's also going to be the labor market. Does the labor market continue to cool? If you take away government, leisure and hospitality, and healthcare, you see no gains in employment. So once those three industries run out of steam, what do you have? And also the economy in general. Does the consumer stop spending and really slow? So I think if the economy slows a lot, labor market continues to slow, and inflation is headed back to the 2% target, the Fed will feel comfortable with cutting interest rates. But it may not be in March. It may be a little bit later this year, again, around mid-year.
Is that when we'd expect to see it in jobless claims as well? Because, Dana, it's not just about CPI this morning. We've got jobless claims at 202,000. It's just absolutely incredible. When would you expect to see that start to inflect higher?
Sure. Well, the reason why initial jobless claims are so low is that our own data say that CEOs of large companies are not looking to let people go. They're hoarding workers, holding on to people. But certainly when people are let go, it's taking them longer to find a job. So continuing claims are ticking up a little. And we do think that's going to show up more so in the unemployment rate.
Are you modeling out a wage growth that sustains above inflation And so America sees a legitimate, real wage growth?
Well, it is possible that wages will remain above 2%. Certainly when we look at the gains over the last few years, yes, they were really outsized. We are seeing slowing, but you do have some industries that wages are rising, certainly in construction, in particular non-residential construction, where there's a lot of impetus to build infrastructure and factories at home due to industrial policies. So you could see wages settle out at a rate that's above 2%.
I mean, I looked, Dana, at the inflation data, and I want to go back to it. You know, this used to be religion 30, even 40 years ago. PPI was just as important as CPI. That all went away. But in tomorrow's PPI report, I know it's rejiggered. McKee's explained it to me 3 times. I flunked the McKee quiz 3 times. Dana, final business inflation, is it legitimate?
Sure it is. Absolutely. It's everything that businesses are looking at, and certainly that includes transportation costs and which are a big thing, and also services, which are quite material. So even though the PPI is different now than it was, 10 years ago, it's still very relevant.
This ties, John, directly into what Linda Dissel said at Federated. It's about margins. And if you've got that inflation input down the income statement, what does it do? Not forget about Apple and all that. In a real American company, I mean, what's it mean for margins? Church and Dwight, they make toothpaste.
Apple's not a real American company.
No, it's not a real American company. It's some luxury stock thing. But to the rest of America out there making 4% revenue growth, I'm sorry, margin erosion could be tangible.
Dana, this was brilliant. Thanks for your time to break this down with us. Dana Peterson there of the Conference Board on CPI data. Just ahead, Tom, PPI data coming up tomorrow morning. You mentioned that as well. Jobless claims out moments ago too. Jobless claims coming in at 202. Mike McKee still around the table with us. Mike, you've had a bit of time to chew over this. Your thoughts?
Yeah, we mentioned housing being the biggest contributor, but also gasoline prices were up 0.2, and that's a surprise after the declines that we have seen in the anticipation that we would see some declines. Also, used cars were up by 0.5%, which is totally the opposite of what was expected. We were looking for another, maybe smaller, but another decline in used car prices. Airfares also up after a big drop in November. So some of the areas that have been a problem all along are still contributing to higher inflation, and it's something to keep an eye on. Food prices up just 0.2. So that's the same as November. So if you look at overall gasoline prices, we did see a bit of a rise in part of December and then a decline again. It's been declining, and food prices down a little bit. I'm doing the Anne Marie part right now, that Joe Biden and the White House can maybe see some progress with the American people, because the things that the people see and think about inflation are down.
I can see you're up to page 14 of the 42 pages. Can you tell yet what service sector inflation is? You were hysterical 90 days ago about some index I never understood. Is there service sector inflation out there?
Well, I can look at service sector inflation here, and services, less energy services, were up 0.4 after a 0.5, so they dropped. Overall services dropped, and we can see what the core rate, the supercore rate was by calling it up. That's the one you like, right? Yeah. That's the one that Jay Powell had talked about, and the supercore is at 3.87% to do it in 3 digits, which is up from the prior month. So.
The key is 3 digits.
I know, it's impressive. Gifted. Mike, do you think Hertz dumping 20,000 EVs on the used car market is going to move the dial?
It could, but the question, that's a lot of cars when you consider that the annual auto sales rate is somewhere around 15, 16 million, the annualized rate. So 20,000 in a month is a lot. But the question is, how many people are going to buy them?
I know.
And I don't know what the average EV price is in the used car market. So is Hertz going to be underselling to try to get rid of them? That would push prices down.
Does that fold through the used car market? Does that go through? You said
that'll go through the used car market because these have been used by Hertz. I think the problem is people did not want to drive EVs because they're not used to them. If you have one, you maybe put a charger in your house and you know how to do it and where the charging things are. But to rent one, I know I've heard from people who got EV rentals, and they're like, what do I do?
Get the anxiety. Get to the airport in a city you've never been to before, Tom.
I don't.
Got to take a journey. You can see why that makes sense. And by the way they're going to sell this, I understand, Mike, they started last month. They're going to spread it out through 2024. So, Tom, it's going to take a while to get rid of this stuff.
Somebody was giving me grief about this. I mean, today, I don't know if you saw this, Mike, I've made a list. I'm a Bitcoin idiot, is what I'm called out there. Maybe I'm an EV idiot,
Can you share that
too.
list with me? I've not seen that list.
I'll show it to you.
Where do you rank on this list?
I'm way down. I'm
okay.
I'm like,
All right,
like bottom run.
But I feel like you're proud of being on that list.
Some would say I'm an EV idiot, but I'm not. John, I will never forget getting in a London cab at Heathrow, and it was one of these new fancy EVs. Blown away. Absolutely blown away.
Smooth, nice and quiet.
Just blown away. It was better than the Bentley.
Conversation's going to continue. I'm not sure I go that far. Craig Trudell of Hertz, on Hertz, of Bloomberg. Up next, equities, just a little negative.
My base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
Was New York Fed President John Williams speaking on the U.S. economy and the outlook for the year ahead. From New York City this morning, good morning. Your equity market shaping up as follows on the S&P 500. Unchanged, TK, following that slightly hotter than expected CPI print about 16 minutes ago. Yields basically unchanged on a 10-year as well. Off the lows, though, so we're back to about 4% on a 10-year. On a 2-year, unchanged on the session. Also off the lows of the session on a yield, 436. So, Tom, initially, equity sold off, yields climbed, the dollar was stronger. We've erased much of that move in the last 15 minutes or so.
I'm going to call it a jumble, and I guess I want to say it awaits for tomorrow's PPI, but I'm not sure the market's riveted to PPI. And I guess it just, once again, John, is just further data. And guess what? There's going to be a lot of microanalysis, including the annualized ballet in that. But there it is, just staggering into 2024 with the real estate. John, it's like used cars. All of a sudden, Teslas fold into used cars. What do? You go up to, there's some famous used car auction in the northwest of the United States, Minnesota or wherever, and there's going to be 4,000 Teslas on the lot.
Tom, look, this is a serious thing. This is a reality check. This is another warning from an American company saying we tried to do this too quickly. The consumer demand is not there. And by the way, I'll throw this in as well. It's not just that the consumer demand is not there. This is costing us a lot of money to carry these cars. A lot of money compared to the internal combustion engine vehicles.
I haven't come up with a cute phrase for Davos yet, but the bottom line is that's what's new at Davos this year, is every single fancy executive at Davos has to worry about cost of carry within whatever their business is. It's a changed world.
Hertz is negative by 4% in the pre-market. It's interesting that Tesla in the pre-market is only down by 0.5%. The bulk of the vehicles in that fleet that they had, the EVs at Hertz, were Teslas, Tom. And if it's Hertz and the other car rental companies facing a similar problem, signaling that lack of consumer demand,
how does
you wonder where it shifts from here.
React to this?
I think that's the right question.
Yeah.
Because the one we've been asking, and Dan Ives of Wedbush sat in that chair, a month ago, a few weeks ago, and he said, are we finding out, do we just want Teslas and not EVs? Where does it leave GM? Where does it leave Ford? If you ask management, and we touched on this earlier, if you ask them, is this a shift in execution or strategy? They will always say execution. And I'm trying to work out, Tom, when we actually get a shift in strategy, when they start to reconsider the ultimate destination for this. Because this government is clear about where they want things to go. We know the objective. What we're finding out is we can't get there as fast as they'd like us to. When do we start to question the ultimate objective?
We don't have time here based on the breaking news, but what does the next government say if it's a second-term President Trump? There's going to be a whole different view, and that goes to the politics of EV up to the election. That's off story today, but nevertheless there it is as well. Why don't you bring in our next guest, because he's the only one of us that has a driver's license.
Craig Trudell joins us now. That's a good point of Bloomberg. Craig, great to catch up, sir. I guess just your initial reaction to this one as it dropped in the last hour or so.
It's just fascinating to me because I think back to when Hertz announced that they were going to buy a ton of Teslas. This was 2021. We were still in kind of, the meme stock, era. It was very clearly, to me, it seemed like a play on the part of, just bankrupt Hertz to really generate interest in the company and interest in their strategy going forward. And it made Tesla a $1 trillion company. And it was soon thereafter that, it was about a year ago now that, we saw in the regulatory filings that Hertz was actually buying a whole lot fewer Teslas than they initially announced, and even falling well short of their plans for the number of Teslas that they were going to purchase. They've really sort of taken a bath on those purchases. It can't help that Elon Musk has cut price so much. And that's got to be a big factor here.
Craig, unfair to you, but let's try to go there. What's a new Tesla cost? What's a used Tesla cost now? And what's it going to cost in 90 days?
Yeah, I think if we think about, the cheapest Tesla you can get your hands on, right, a Model 3. I mean, this is a car that, was supposed to, out of the gate, cost $35,000. The company is now fairly close to that in terms of, how much you can pay for a new one. And that moved down dramatically last year. This is a company that just repeatedly was cutting price to try and keep growth going, and it was effective in helping the company to continue to increase volume. But they really took it on the chin in terms of margin, and it really burned Hertz. And over here in Europe as well, you've heard rental companies gripe about what the price cuts have done. From a depreciation standpoint for their fleet.
On a $35,000 value, then, what's that used car going to be in 90 days?
We're seeing the 90-day question is a little bit tricky to answer, but I will say that one of the things that we saw, just as Hertz has started to list these cars on its website, is that you can, get your hands on one for like $16,000. And so, this is pretty substantial depreciation for a company that only was buying Teslas just in the last couple of years.
Craig, I want your view on this. Tom and I have been talking about it over the last hour or so, ever since this news came out. But I think it's been a topic of conversation now for months. This is another reality check. When you speak to the manufacturers, the big automakers in this country, they talk about a change of execution, not ultimate strategy. I think they all agree on the ultimate destination, the objectives of this administration and how it's going to support them. At what point do we start to question the ultimate destination? Where is this industry going?
I think if we take a step back and think about this from a global perspective, we're not necessarily seeing this, sort of disastrous result in China or over here in Europe. So I do think that this is a bit of a U.S.-specific phenomenon where you've had a really dominant player in Tesla that was pushing for years. And, maybe, the fact that they pushed on a string to some degree in the U.S. just in the last year and a half or so. And we've seen this really sort of, cyclical change in the auto industry, which we've seen, over a long period where you see companies kind of, boom and bust quickly. The question is whether or not this is a U.S.-specific and Tesla-driven phenomenon. It seems to be the case that, this company that's been very successful maybe, got over its skis to some degree, and the rental companies are taking it on the chin.
Pabst Blue Ribbon ago, John Ferro had a blistering conversation with Mary Barra. How did GM and Ford react to today's bombshell announcement? John, what's a pickup truck cost? Like $150,000?
Well, an F-150 Lightning.
Yeah, whatever.
If you deck it out, it's going to be pretty expensive.
Craig, why can't we make a $38,000 GM whatever to compete with the Elon Musk company?
I think the fact that Musk has been at this for so long, we're seeing, to use his phrase, production hell on the part of GM and Ford, where, these are companies that have a long history of making combustion engine cars. They don't have nearly as long a history, of course, making electric vehicles. And they and their battery partners are really struggling to scale up the way that we saw Tesla have challenges with the Model 3 years back. And so you've seen Tesla jump out to this big lead, it's been a long slog to bring costs down. We've seen, similarly in China, a ton of investment, a lot of losses, a lot of, negative headlines for many years for some of the companies in China, where, we've seen Tesla and BYD really emerge as the very clear 1 and 2, but it hasn't been a sort of, clean story of all as well.
Craig, thank you, sir, for jumping in front of a camera in London. We appreciate it. Craig Trudell there of Bloomberg out of London on the latest with Hertz, needing to sell 20,000 EVs and replace some of them with internal combustion vehicles. The stock is down by about 3.85%. Tom, the standout from that conversation, just how unique some of these issues are to this country. That these are headlines we're seeing in America and maybe not seeing them in the same way in Europe and elsewhere.
We're not seeing them there because are we bringing in Chinese EVs into America? And that's a huge distinction for German manufacturing America. I want to be accurate here. We try to be accurate on surveillance. John, it's the LEVC TX electric taxi. Mayor Adams, can you just bring them to New York? That's all I want, John, is some fancy 5 or 7 year pay structure for our cab drivers and cab companies to bring the best cab I've ever sat in my life.
You love that cab, don't you?
What
is it you like about it? Is it the ceiling?
It's got the weight. Yeah, the ceiling.
Sit in it?
Yeah,
is that what it's really about?
Unlike here, do it again. I can't.
You want me to pull you up?
Unlike the Tesla.
Is that where you're at?
Again, but the bottom line is John, is it's just done right, and that's what we need in our transportation in America.
This was nice. We should do it again.
Yeah, we should.
I'll see you tomorrow.
Yeah, we'll do it tomorrow. You know.
Live from Bloomberg TV.
Bank
and Bloomberg
earnings.
Radio from New York City for our audience
Maybe Jamie
worldwide.
will show up.
CPI behind us, bank earnings coming up tomorrow from New York City. This is Bloomberg.